Hello, everyone. Good day, good morning, wherever you're joining us from. Most of you in Nairobi, I'm sure, so still morning. It's great to have you all on the session. So thank you for joining us. I'll just give everyone a minute or two to get their audio settings right to join us in this session. I see our participation numbers are climbing up quickly, so take a moment just to get your settings sorted. You may also like to introduce yourself to everyone in the chat, say who you are and where you're joining from if you'd like to. And otherwise, we'll give it another 30 seconds or so, and then we'll be getting started. Okay, everyone, thanks for joining us. I think 100, nearly 100 of us in the room is a good number to get going with. So let's get started. So again, thank you all for joining us so much today to this full day or half day of training on the IFRS Sustainability Disclosure Standards. So this program is a truly collaborative effort, really driven by that demand that we're seeing from the market for more support and capacity building on this topic. And we'd like to thank the Nairobi Securities Exchange for having us here today, as well as the IFRS Foundation, IFC, Bloomberg Philanthropies, and of course you as our participants for joining us. So before I go through some introductory content, I'd first like to thank Demi Marilla for joining us, who's Communications Officer at the NSE. So Demi's going to give a few opening remarks from the exchange perspective. So thanks again, Demi, and the floor is yours.
Good morning, everyone. Fiona, thank you so much. I just want to start off by introducing myself. My name is Demi Marilla from the Nairobi Securities Exchange. I am a communications officer, and welcome everybody to the SaaS training. It's my pleasure to welcome you all to the ISSB training hosted by the NSE. We are delighted to bring together market participants, regulators, and sustainability professionals for the critical learning opportunity and global sustainability standards. As the financial landscape evolves, the integration of ESG considerations into corporate reporting is no longer optional, it is essential. The ISSB standards mark a significant step towards enhancing transparency, comparability, and investor confidence in sustainability disclosures. At the NSE, we remain committed to equipping our market with knowledge and tools necessary to navigate this transition effectively. We look forward to an insightful discussion and practical takeaways for today's session. I thank you all again, once again, for joining us, and let's make the most of this opportunity to learn, engage, and drive the progress in sustainable finance. Thank you very much. I'll pass it on to Fiona. Thank you.
Great. Thanks so much, Demi, for that introduction to the session. And thank you again to the NSE for hosting us here today. Brilliant. So I do also have my colleague Rose from the IFC here, but unfortunately, unless you've been able to resolve it in the last moment or two, Rose, I know that you've had some audio issues. So I'll just give her a second in case she's back. I don't think so. But I just mentioned Rose Lumumba is joining us from the IFC International Finance Corporation, which is part of the World Bank Group. She is based within the ESG team of the East Africa office in Nairobi. So I think Rose may be available to say hello in the chat briefly. So if you do have any questions for Rose, please do flag them there. But just to say that the IFC offer a lot of resources on corporate governance, ESG, capacity building through the Disclosure and Transparency Programme, which we'll mention a bit later in the programme. So Rose, I think, was going to mention those, so I'll just do that on her behalf. But again, sorry for those technical issues we've had there. But with that, I'll move on to a few more practical points just to get us on the same page as we start the session. So you will notice that everyone is on mute during the session because we're a large number of us here. However, that's really not to say that we don't want you to engage in the session. So please do make sure you're using the chat function throughout, as I see you've started to do. Feel free to share any comments that you might have there. If you have any particular questions for the team, please do ask them, but make sure that you're putting those into the Q&A box that you'll see on the bottom panel as well. And that allows us to really track each question and answer it properly, rather than potentially getting them a bit lost in the chat. So make sure to use the Q&A box for any questions. And so in terms of how the today's workshop will work, we have 3.5 hours together in live facilitation, and there is a short homework assignment that you can complete afterwards if you'd like to continue your learning as well. There's live Q&A, as I mentioned throughout, so please make sure to take the opportunity to ask those questions. As I'll go on to explain, we're joined by some really experienced colleagues from the IFRS Foundation who will be on hand to answer your questions, so make sure to get those questions out if you have them. And as I've mentioned already, we very much encourage and indeed expect your participation in the session. We're going to be using Menti as an interactive tool, as well as polls and the homework exercise. So we really encourage you to take part in the session, share your thinking and maximise your learning through that route as well. And finally, you'll be pleased to know that if you complete today's session, you'll be able to receive a completion certificate. To do that, you'll need to complete the feedback survey. We'll be sharing that at the end of the session, so please keep an eye out for that at the end, and we'll also send it via email from the Zoom platform afterwards as well. Okay, so those are the practicalities out of the way. And then just to introduce who's going to be delivering the training today. So I'm Fiona Quinlan-Wells. I'm a training officer within the Sustainable Stock Exchanges Academy team. I'm joined by my colleague Lois Guthrie, who is our senior specialist. And we also, as I've mentioned, are very happy and pleased to be joined by our colleagues from the IFRS Foundation directly. So firstly, Bella Cheng and Robert Swiatowski. So thank you to both of them for joining us, and you'll hear from them both later in the session as well. So in terms of what we're hoping to achieve in today's session, we have 3 kind of key learning objectives for you. So firstly, we hope that you'll come away with an understanding of the ISSB standards. We'll hope you'll have some understanding also on how you can use those standards. And finally, we'd like to help you identify what steps that you can take to develop a disclosure plan to apply the ISSB standards. So that's the structure we're going to be working through today to help you in those areas. And so to achieve those 3 objectives, we've broken down our training into 4 key modules, which you'll see on the screen there. And we'll take each of those modules in turn through the programme. So firstly, we have prepare, all around building the case for sustainability reporting and understanding its landscape. We then have align, which is all around understanding how you can apply the standards and what additional disclosures you might need to add to be in accordance with them. Then moving through, we have implement, all around your practices and systems for reporting. And finally, we'll be moving on to communicate. So thinking about where to locate this information, how to report efficiently, and provide confidence to your stakeholders. So of course, we've represented this as a nice wheel diagram here with the arrows, but we know, of course, that all of these activities often happen in parallel. You may have to go back a step sometimes as well to re-establish processes, etc. So of course, we know that this is very much a cyclical, constant improvement process, but we'll be working through them in this order today, just for the purposes of the training. And then building around those 4 modules there, we have this agenda that we'll be working to. So we'll be starting with the first 2 modules, as you might expect. We will take a short break in the middle of the session. I know it's a long time to be online in this environment, so we'll make sure to give you a quick break to refresh, and then we'll carry on with the rest of the content afterwards before we wrap up with some additional resources that may help you and talking about that homework as well. So that's everything for the agenda side of things. We'll mention as well at this stage that the SSE have developed quite a few different training materials to support you on the IFRS and wider sustainability disclosure topics. So these can be found in the web page that Lois will have shared the link to there in the chat. And you can also access those if you just go directly to our website as well. The handout materials from today's session will be available on our website, and those contain all the links to the resources we're talking about in the session as well. And we'll include some extra resources for you in the chat as we go along too. And I mentioned already the homework assignment that we're proposing for you. The idea of this is that it supports you to develop your first draft disclosure plan for your company, putting into practice what we've learned today. So this isn't mandatory for you to complete or submit, so there's no need for it to be sent to us to be marked or anything, but it's just something that we hope will support you to build on your own learning from today and take forward your conversations internally. And the way that you can access the homework assignment is to go to the web page that Lois has shared with you for today's session. And within the resources section there, you'll be able to download the homework alongside the slides as well. And then just a few further resources that we wanted to flash up for you, which again, you'll be able to access at your own time in the slides, but some of the wider materials that the SSE have in our toolkit to really support you across sustainability reporting, be that on transition planning, climate disclosure metrics, and thinking about the gap analysis for how to address and improve your disclosures as well. Okay, so that's everything from my side in terms of the initial opening. But what we'd like to start with after this now is a quick Menti exercise to make sure, firstly, everyone can access Menti, and also that we get a bit of a sense from you of why you're joining us here today and how much you already know. So we'll be sharing with you very shortly a link to access Menti in the chat. And then I'll take you there on the screen as well so we can show it together. Great, thank you, Lois. So if you follow that link that Lois has shared there, that will take you directly to Menti. But what I'll also do as well is I'll share my screen in Menti so that you could see the details to access it there as well. So if you have joined us via the link, you should already hopefully be able to see this. And if you otherwise want to try and access it a different way, you can use that QR code you could see on my screen there. You can also go to menti.com and use that code that you see at the top of the screen. So a few different ways for you to join us. But when you get there, it'd be great if you could give us a few words that tell us why you've joined today's training and what you're hoping to get out of it. Okay, brilliant. I see learning. I see Trump. Interesting. I'm not sure how much we'll talk about Trump, but it's an interesting one. So I see diversification, skills enhancement, upskilling, gaining knowledge, learning the basics, compliance, alignment, benchmarking, new skills enhancement. Okay, brilliant. I hope the majority of those are things that we're going to be able to address with you today. This is all about, as you say, learning, building that journey in your understanding. So from whatever level you're coming at to us now, we hope we can help you move forward in that today. Perfect. I see lots of you have been able to access Menti okay as well, so that's brilliant. So we have one more quick question for you now, which I'll just move on to, although I see lots more words coming through. Thanks, everyone. And our next question is just to get a sense from all of you as to how comfortable you are on the different learning objectives that we've set for today. So where do you think you are at the moment on those areas in terms of explaining what the ISSB is, using the standards, and developing a sustainability reporting strategy? So just take a moment to use those sliders there to let us know from left-hand side being not very comfortable to the right-hand side being sorted, already on with it. Let us know where you think you are today. Okay, thanks everyone. See quite a few of you already responded, and mostly we're coming sort of a two kind of lowering middle confidence at the moment in those areas. It's fairly consistent spread across that area. So That's really useful to understand. And of course, that's exactly why we're here today. So no worries at all if that's where you currently are. We're here to help, and we hope we can help you to progress that through today's training. Great. So that was a good way to make sure that we could access Menti as well. So please keep Menti open on a second screen or in another tab, because we'll be coming back to do some more exercises in Menti later in the session. So I'll leave that with you. But we'll return back to the presentation now to get into the first module. Okay, so before we start that, I just had a very brief disclaimer that I wanted to leave on the screen for you to just read there. It's really about being clear about how we're going to be using examples and case studies in today's training session. So these are really just here to add a bit of colour to what we're talking about, because we know sometimes it can be helpful to see a real world example to put into practice what we're talking about. However, we just want to clarify that any examples that we do use shouldn't necessarily be seen as the best or the right way to do things. It's really very dependent on your company and your context as to what is the best way to approach these things. But we hope we can offer you this a bit of inspiration to get you started. Okay, so with that introduced, I'll be going through a few elements in our first module all around building that solid foundation of knowledge. So this is really all around building on what you already know. So although the ISSB standards may seem like something new, actually they build on so much that's already there in terms of existing knowledge and frameworks. So we want to make sure that you're starting out with that context. So here we like to generally cover three important aspects on why to disclose sustainability related information, how the landscape of disclosure guidance has evolved to reach the ISSB standards as they're here today, and finally to give you an overview of the standards themselves. So to get started with the why aspect, that is going to be about looking at the purpose. And so we're first diving in here into the case for disclosure and the market drivers that are really influencing this. So to get us started with thinking about that, we'd like to know what your reasons are at the moment for disclosing sustainability related information. So I have a quick poll for you here that I'll just launch for you now. So here are the main kind of reasons that we think you may have. So this is around maybe regulation, around sharing your management's objectives, perhaps peer or competitor comparisons or pressure. Maybe your investors are interested, or perhaps you have other reasons as well. So feel free to share those in the chat with us if there's a different reason than we've given there. And of course, maybe you're not yet disclosing and you're not necessarily sure of the case for disclosure either as well. So if that's the case at the moment for you, that's absolutely fine. Just let us know that. Okay, great. I see lots of you responding. I'll give everyone a few more seconds to get their answers in there. Okay. Great. I see over 100 of you have been able to respond. So I'll close the poll there if that's okay, and I'll share those results. Like I say, so we see a range of options here, but it looks like the regulatory driver is the strong one for many of you, which is understandable, and we often see that. And then the second option there around investor interest being another key driver, and perhaps sharing your management's objectives as well. So that's really helpful for us just to understand what brings you here today. I think that is a very common picture that we often see across these sessions as well in other markets. So you're in good company in that sense. Okay, so moving on from that, we'll go into a little bit now about, what the case for this might be and where those pressures are coming from. So as I know many of you highlighted there, investor interest in this topic continues to grow. And one way that we just want to highlight that is through the number of signatories to the Principles for Responsible Investment, which has maybe started to level off a little bit, but has grown massively in recent years. So there are now more than 5,000 signatories to the UN Principles for Responsible Investment, representing more than 128 trillion US dollars in assets under management. So what's really driving this interest from the investor community in sustainability? And what we really want to highlight here is that the key driver behind this investor interest is indeed the financial effects of sustainability risks and opportunities, not just a philanthropy or an impact driver, but really a feeling that these are impactful factors on risks and opportunities. So here is a study from retail investors done by Morgan Stanley. And this is where they found that the top driver, at least for individual retail investors in this study, driving their interest in sustainability was the financial performance of sustainable investments. And so you can take a closer look at this study by following the link that you see there in the handout. But let's look a little bit closer before we move on at what we mean by financial performance there. So it's important to remember today that we're talking about disclosing financially material sustainability related information. And while we're going to discuss in more depth in the workshop what the word material means, we want to be clear from the start what sorts of financial effects investors are looking to have more information on. So let's start with the effects on a company's performance, which we often see in the statement of profit or loss, showing revenue and expenditure. So sustainability-related risks and opportunities can have a financial effect by changing the revenue mix or total revenue of a company, perhaps if demand for its products and services change, or total revenue of a company may change if its production capacity is disrupted, for example. And we can also see substantial changes in expenditures if, for example, operating costs might increase due to energy prices increasing, or if there's a need for greater research and development expenditure to capitalise on sustainability-related opportunities as well, or perhaps any costs there might be in deploying new practices to meet sustainability requirements or manage risks. And so another thing that you'll hear us talk about today are effects on a company's financial position. So let's look at also what that means. And so we often see a company's financial position on their balance sheet, known as a statement of financial position. So for example, a company might experience changes to certain asset values or liabilities due to climate or sustainability issues. We may see changes to portfolio value. We might even see write-offs of certain assets that are damaged or need to be repriced as a result of sustainability risks. And another financial effect that should be documented is changes to financing and the cost of capital. So that can include, for example, insurance premiums that may increase due to climate risk exposure, as well as making use of new financial instruments, such as green bonds or social bonds as well. And then before we move into our next module, I just want to flag two important aspects of sustainability-related risks and opportunities, which are really essential to our understanding of them and our disclosures. So as you can see here with the latest Global Risk Perception Survey from the World Economic Forum, which you may be familiar with, risks are continuing to evolve over time. So something that might pose a risk in the next 2 years may not be the most material risk 10 years from now. And in turn, there may be risks that are material in the future that we're not even considering yet. So what's quite important for our disclosure is that we're preparing for those risks that we're expecting to arrive in the long term, because actually we may need to invest today in new practices or processes to mitigate any negative impacts and capitalize on opportunities as well. And that can, of course, mean as well that those financial effects we were just talking about could happen sooner if we need to make changes in the near term. So that's just something we want you to keep in mind for today's session. And another important aspect of sustainability-related risks and opportunities is their interconnectivity. And here we have another visual from the World Economic Forum's Global Risk Report, which shows the interconnection between different risk topics. So whereas many people might think of the different ISSB standards that we have, S1 on sustainability disclosures and S2 on climate, as separate topics, in practice, of course, we know that all of these issues are very much interconnected, and therefore separating out one topic or theme doesn't remove those interconnections. We still need to ideally consider that whole when we're making strategic decisions. And of course, the way that we deal with these risks and opportunities in terms of our mitigation and management measures will, of course, need to be connected as well. So when you're disclosing information about climate risks and opportunities under the S2 standards, you also should be applying the requirements for S1 insofar as they relate to that information. So again, just another key point that we want to establish at the start. Okay, so that covers everything from my side regarding the purpose and business case for reporting. Going to hand over to Lois now for the next segment. Thanks, Lois.
Thank you, Fiona, and hello, everybody. So Fiona has taken us through why sustainability information is important. So having covered the why, let's look at how the IFRS sustainability disclosure standards developed in the landscape of existing reporting standards. But before we do that, let's have another Zoom poll. And this Zoom poll particularly asks which frameworks you are currently using. And while that's loading, I think I just mentioned to my colleagues that I've just lost access to moving the slides. So if that could be restored, that would be lovely. So everybody, the Zoom poll asks you, please could you tell us what frameworks you're currently using to make your sustainability disclosures? And the options are, hopefully you see this poll appearing on your screen. Is it CDP, GRI, integrated reporting, SASB, the Task Force on Climate-Related Financial Disclosures, the UN Global Compact, or others, and you can select as many of these as you use. You can see that well over half of you have participated now, so thank you very much for responding to the Zoom poll. So I'll end the poll here as there's a clear pattern emerged and share the results with you. And you can see that in this community, the majority of people are using the integrated reporting framework followed by GRI. And that it's good to know that. That'll be relevant when we come to some of the next slides. I'll explain why that's relevant. So thank you very much for letting us know that. And we will move on to look at the structure of the International Financial Reporting Standards Foundation. What is the IFRS Foundation and how did the ISSB come to be? As you know, the International Sustainability Standards Board is the board that developed the standards we're going to be looking at in detail today. So the IFRS Foundation is a not-for-profit public interest organisation. It was established to develop high-quality, understandable, enforceable and globally accepted accounting and sustainability disclosure standards. At the bottom of the screen, you can see that the Foundation hosts two independent standard-setting boards. The International Accounting Standards Board, IASB in the dark blue, was formed in 2001, and the IASB standards are in place in over 140 jurisdictions around the world, explaining how financial statements should be prepared and presented. The International Accounting Standards Board was formed in 2021 and released its first two standards in 2023, following strong market demand for its establishment. Given that these two boards are within the IFRS Foundation, the two boards work closely together to ensure that their standards complement each other. Governance of the IFRS Foundation and their standard-setting boards is provided by trustees, and those are in turn accountable to a monitoring board of public authorities. So how did these standards evolve? You can see on the screen here lots of different logos, some of which you'll be familiar with. It looks complicated, but actually the main message to take from this slide is a message of simplification. All of the organizations whose logos you see on the screen have contributed to the evolution of sustainability reporting. They actually have a lot in common, but they have different objectives, guidelines, and standards that have caused some confusion in the market, with some people calling this an alphabet soup. Most of the organizations on the screen focus on meeting the information needs of investors for sustainability information, except GRI, who focuses on investors and a broader range of stakeholders. Now, some of these organizations, including the Integrated Reporting Council, whose framework many of you are using, have been consolidated into the IFRS Foundation, and their work, together with the Climate Disclosure Standards Board and the Sustainability Accounting Standards Board, you see at the bottom of the screen there, has been consolidated into the work of the IFRS Foundation Sustainability Disclosure Standards, and therefore you might find some of what we say today to be familiar to you if you're already using integrated reporting. The ISSB standards were also built on the recommendations of the Task Force on Climate-Related Financial Disclosures. The TCFD has now been disbanded and its work is now within the ISSB standards. The CDP's questionnaire is now aligned with the ISSB's climate standard. And also we see on the left-hand side of the screen there, the Transition Plan Task Force, their work has also been taken over by the IFRS Foundation to the extent that it relates to disclosure. So, as you can see here, consolidation, harmonization, and simplification all coming together in the IFRS Foundation. So let's do another Zoom poll now. And the Zoom poll this time asks for one answer only. Companies who disclose using the Task Force on Climate-Related Financial Disclosures recommendations automatically comply with the ISSB standards. Is this true or false? Lots of you participating, which is great to see. Thank you. We have over 50% participation. So I'm going to end the poll here and share the results with you. 52% of you said that this is false and 48% said it's true. So we can see that there's a bit of uncertainty about the answer to this question. In fact, those of you that answered false, so most of you were correct. It is false. So if you already use the Task Force on Climate-Related Financial Disclosures recommendations, it does not automatically follow that you conform with all of the ISSB standards requirements on climate disclosure. They are very, very strongly aligned, the TCFD and ISSB standards, a lot of similarities, but there are some differences that we'll look at later. And therefore, although the last slide showed us there's been a lot of consolidation and harmonization, there are some slight differences between the standards, and therefore please don't assume that if you have used TCFD that you are automatically complying with ISSB. But thank you very much. Most of you got that right. So let's look now at the next slide. This is called Moving from TCFD to ISSB. And what you see in the little thumbnail picture there is a document that's being developed by the ISSB showing how the TCFD recommendations and the ISSB climate disclosures compare. So the general message is that although they use different wording in some cases, it's to capture the same information. The main message to take is that in some cases, IFRS S2, which is the climate standard, requires more detailed information than the TCFD's recommendations. But IFRS S2 does also contain some additional requirements and guidance. So, for example, S2 requires companies to use sector-specific standards for their climate disclosures. So moving on now, let's look a bit more at the landscape. as we saw, the landscape has evolved over time, and the IFRS Foundation's work through their sustainability standards is designed to provide a common language and a global baseline for sustainability information. Now, this global baseline is designed to enable comparable and consistent sustainability disclosures across global capital markets. And the IFRS Foundation is working with jurisdictions around the world and with other stakeholders to achieve this. So regulators and stock exchanges and others are able to require companies to disclose information in addition to the global baseline by using building blocks, as we call them, tailored to meet those needs. So, for example, a particular jurisdiction or stock exchange could add disclosures to the ISSB's global baseline, including requirements that come from the GRI or other jurisdiction-specific information that is beyond the ISSB's remit, but is relevant to users of information in that jurisdiction. So taking this global building block approach and the global baseline approach reduces the need to duplicate information, because we have this globally consistent baseline of disclosures, whilst allowing jurisdictions and others to add requirements to elicit additional information based on standards like the GRI standards. So that explains the global baseline. And just to let you know, there's been significant global backing for this baseline. So the standards themselves represent the baseline, and they were issued in 2023, as we saw. IOSCO, which is the International Organization of Securities Commissions, has endorsed the ISSB standards as a global baseline and has asked their 130 members to consider how they can incorporate the ISSB standards into their regulatory frameworks. We see complementary activities such as from the insurance community that will enhance and develop assurance standards for sustainability information. And for example, the International Auditing and Assurance Standards Board has recently launched a new assurance standard for sustainability information. As part of its regulatory implementation program, the Foundation is supporting multiple jurisdictions around the world with planning and preparation for voluntary and mandatory adoption of the ISSB standards. And of course, the Foundation is also talking to stakeholders around the world who are planning to support voluntary disclosure against the new standards. So that was a little look at the landscape and how it's evolved. And I'm now going to hand over to our colleague Bella, who will take us through looking at some of the standards.
Thank you so much, Lois. Okay, now let's move on. Okay, we've talked about the business case and the market case for sustainability reporting, the evolution of the landscape, and how it is being simplified and rationalized. Now let's introduce IFRS S1 and S2. Okay, as we start, it's important to note that there are some key terms that should be understood. You can find the definition in your handout, but I wanted to briefly mention them here. First of all, we will be saying the phrase sustainability-related financial information quite a lot. Well, this can refer to a broad set of issues, including climate, nature, or biodiversity, human, social, or others. Sustainability-related financial information is information about a company's sustainability-related risks and opportunities that is useful to investors in making decisions about providing resources to the company. Another phrase mentioned is sustainability-related risks and opportunities, which are those that could reasonably be expected to affect the company's cash flows access to finance, or cost of capital. It could affect the company's prospects. We will also often refer to general purpose financial reports, which includes a company's financial statements and management commentary. You might know this as a management report, management review, or strategic report. Some regulators require specific disclosures in certain parts of general purpose financial reports, so we use this generic phrase throughout. Okay, anyone familiar with TCFD will recognize the same 4 core pillars or content areas for the SSB standards. These are governance, strategy, risk management, metrics, and targets. For each core content area, there are a set of key disclosures to be addressed, and the standards provide very detailed guidance on these requirements. We will discuss each of the 4 content areas today, but I encourage you to download the standards as part of your homework assignment. Okay, now let's start with IFRS S1, or to give it full title, General Requirements for Disclosure of Sustainability-Related Financial Information. IFRS S1 sets out general requirements for the content and the presentation of sustainability-related risks and opportunities. If you are familiar with TCFD, you will see the same architecture applied throughout the standards. S1 asks preparers to refer to and consider the applicability of the SASB standards and other sources of further guidance to identify sustainability-related risks and opportunities, and identify material information. The SASB standards are organized by industry, enabling a company to identify disclosure topics and metrics applicable to its business model and operations. Finally, the standards can be used in conjunction with any accounting requirements. The scope of S1 is all sustainability topics, except for climate, which is covered by S2. So the second standard, S2, focuses on climate disclosures, building on the same foundations of S1. For example, it fully incorporates the recommendations of TCFD, and it sets out the requirements for a company to disclose material information about its climate-related risks and opportunities. And also, it requires the disclosure of both cross-industry and industry-specific information. In terms of climate-related risks, these include both physical and transition risk, which we will come back to later. Other specific climate-related disclosures are required, for example, on scenario analysis and the GHG emissions. And also, preparers must also refer to and consider the applicability of the industry-based guidance on implementing IFRS S2. As we've said already, this is organized by industry, enabling a company to identify climate-related disclosure topics and the metrics applicable to its business model and operations. S1 and S2 are not standalone standards. They are a package and must be applied together. Even when a company is reporting only on climate-related risks and opportunities, the company must apply both IFRS S1 and S2. This is because S1 sets out general requirements or parameters for the type of information that needs to be provided in order to be decision useful for investors. S1 also explains the concept of materiality and how companies identify material sustainability-related financial information. Next, let's consider some of the conceptual foundations that underpin the ISSB standards, which might be new to anyone without an accounting background. So these concepts help us to understand how best to disclose information in order to meet the requirements of the ISSB standards. To start with, companies must fairly present a complete set of sustainability-related risks and opportunities. Fair presentation also requires disclosure to be faithfully represented. To achieve this, companies shall provide a complete, neutral, and accurate depiction of sustainability-related risks and opportunities. In terms of the reporting entity or reporting company concept, this concept requires the organizational boundary for sustainability-related financial disclosures and financial statements to be the same. Another important concept is connected information. We saw earlier when Fiona explained how different risks are often interconnected. The ISSB standards require companies to clearly identify key connections, such as those between risks and opportunities, connections between the 4 content areas, and connections between sustainability-related financial disclosures and the main financial statements. So now let's take a look at an example. Over to you, Lois.
Thank you, Bella. And just before we get into the example, I'd just like, as it is the first example, would just like to remind you of the disclaimer that Fiona gave at the beginning to say that the examples we're using today are just for illustrative purposes. They are simply to inspire you and to illustrate certain things. They are not meant to represent a best practice. Some of them were actually developed before the standards were live, or before the standards had sufficient time for a year to pass and to be included in disclosures. But this first example is to illustrate the connections, the connectivity that Bella was just talking about. And the connections here are in a report from BHP, which is a global mining company, from their 2023 annual report. And what we see here is a disclosure about connections between the company's decarbonisation strategy and its financial results and processes. There are 3 main things we see being connected here. First of all, the decarbonisation strategy and the investment process and decision-making are connected. So you can see that in the first paragraph, BHP says all investment decisions consider the quantity of GHG emissions associated with the project, the cost per tonne of CO2 equivalent associated with the project, and the alignment with the group pathways to a net zero trajectory. So the first thing to note is investment decisions are connected with the decarbonisation strategy and group pathways to net zero. The second thing we see being connected is the decarbonisation strategy with various types of expenditure now and in the future. So we can see from the disclosure how much was spent on operational greenhouse gas emissions in the reporting year. So in the second paragraph there, you can see that this was $122 million. But we also see what the company anticipates spending until 2030. This is in the third paragraph, and that spending is anticipated to be $4 billion. Thirdly, we see the connection between decarbonisation projects and net present value. This is in the penultimate paragraph, the second from the bottom. So the company says, based on current assumptions, the achievement of medium-term targets is expected to deliver positive net present value for the group, as it has done on already implemented projects. So 3 things we see being connected there. And note just at the bottom, we've got some orange text, and that connects or gives you a reference to a place in the report where you can find more information about this. Back to you, Bella.
Thank you, Lois. So let's move on. After a presentation and explanation of an example, we are going to take another Zoom poll. Okay. So this Zoom poll is about connecting information. So this is a multiple choice Zoom poll. So what information should be considered for connecting information? Connections between governance, strategy, risk management, and metrics and targets, sustainability-related financial disclosures and financial statements, or sustainability-related risks and opportunities. So let's wait for a few more seconds to get more participation. Okay, so there's already over 50% participated. So I'm going to end the Zoom poll and share the results. Okay, as you can see, well, I think the one who chose option C is less than the other two. And well, I think this question should be simple for all of you because, well, we just introduce and explain that what is connected information and which three aspects that we can consider in terms of connections. So the right answer is all of the answers are right, are correct. So you should endeavor to have connectivity between all of this. Okay. So let's move on. Okay. Well, finally, the standards are built on the concept of materiality as defined by the IFRS Foundation. We are going to go into this in more detail later, but just to highlight that we will be referring today to material information, which is information that, if omitted, misstated, or obscured, could reasonably be expected to affect investor decision-making. Okay. During the SSB consultation on the exposure drafts, one of the key feedback topics was the importance of supporting preparers, particularly those with more limited resources and those in emerging markets. In addition to the standards and the application guidance published in 2023, a number of educational resources were also published, and since then others have followed, including the IFRS Knowledge Hub. We're also in the process of gathering examples and the case studies provided by our partners. The SASB standards were aligned with IFRS S2 to help preparers seeking industry-based guidance, and the FIC credential was also updated, with more planned to come. I should also note that the IFRS Foundation's capacity building program, which is launched at COP27, is a key part of our support to preparers, and the SSE training initiative is one of our most important deliverables. Okay, now it's time for another Zoom poll. So the question is, water is a vital input to our business, but the SSB standards do not currently have a specific standard on water. What do you do? And just a reminder that this is a single choice question, so only one question is correct. Only one option is correct. Okay. Now we have more than 50% participation now. Okay, so I'm going to end the poll and share the results. Okay, so as you can see from the result, well, there are 82% of participants choose the option B, which is consult the source of guidance listed by SSB. Well, I think most of us have choose the correct answer, and this is option B is really the correct one. And as you can remember that the SSB standards, especially in S1, sets out that in the absence of other topic or theme standards from the SSB, you can refer to the sources of guidance listed by SSB standards. Well, apparently option A is not the right answer. Well, water is a vital input to your business, which means water-related information is material information for your sustainability disclosure. So option A is not correct. And some may find option C and option B helpful, but for this question, the only correct answer is option B. Okay, so let's move on. Okay, it's time for you, Fiona.
Great. Thank you so much, Bella, for covering all of that. So that brings us close to the end of our first module. So before we wrap this up, we're going to take a few minutes just to recap on what we've covered so far. And then, as I've shared in the chat, we'll have a little Menti exercise to conclude this section as well. So first, we started by reviewing the purpose of sustainability-related disclosures. And a key takeaway that we're hoping you'll leave this workshop with is that there are important benefits, both internally and externally, for collecting and disclosing sustainability-related information. And ultimately, if you're not aiming to make good use of that data that you're collecting to improve your own strategic decision-making, you're going about this wrong and you are wasting some time and energy there in not getting those benefits. Especially if you have operations in difficult to abate or high impact sectors, your competitors could well be disclosing risks and identifying opportunities already. And that would leave your investors wondering why you're lagging behind, which might start to affect your ability to raise funds. And next, we looked at the evolution of disclosure standards, the formation of the ISSB, and the aim to simplify the reporting landscape. So when you're thinking about other voluntary disclosures, you shouldn't see those as competing with the ISSB standards, but rather building on top of them in that building blocks approach that Lois talked us through. And finally, we introduce the standards and the important concepts that you'll need to understand in order to use the standards correctly. And so a key point to reiterate from what Bella just took us through there is that these standards and guidance that comes with them are designed to meet the needs of investors, and therefore they're heavily focused on the prospects that we discussed at the very start of this unit relating to financial performance and position and those connected risks. Great. So what question we want to come to finish up this session, and this aligns with what you'll see in your disclosure plan homework as well if you decide to take that forward, is to think and reflect on how you're going to define the objectives for your sustainability disclosures. So this is all around, setting those goals for your disclosure plan. So it's important to be clear at the start on what you're trying to achieve through your sustainability disclosures, or perhaps if you're reporting already, what you're trying to achieve with any improvements or adaptations. And so here, this is where you should be defining any requirements that you want to align with, such as the ISSB standards or specific jurisdictional requirements, and considering where you already are at this point in time. So what's missing from your disclosures that might prevent you from achieving this? So we'll go back into Menti again now. So I have shared the link in the chat, just a couple of messages above there to Menti again for anyone who doesn't already have that open. And I see lots of you are already sharing your thoughts now. So let me share my screen so that we can look at a few of the answers coming in. Okay, thanks everyone. So yeah, the question here, as I said, is all around just taking a moment to reflect on what do you think the objectives are for you in your reporting. That might be about meeting the needs of a certain audience. It might be about thinking about those internal benefits as well. So here we've got a few responses. So learning more about disclosures, sure. Understanding and incorporating what to include in financial reporting. Yeah, that's a really good point as well, thinking how to connect this. We have informing investors and better regulatory reporting. Yes, absolutely. Being compliant, understanding sustainability matters and how you report them. Thinking about climate risks and opportunities. So having better advisory and potential success to clients raising funds. Yeah, I think that's a great ethos to have in mind if you can think about those types of benefits as well. We have ensuring and my investors have all the information to make informed decisions. Generating business value from sustainability aspects. Being transparent, yes, absolutely. Understanding how to incorporate and report using the standards, identifying and managing risks, and ensuring regulatory compliance, keeping up with changing regulation and stakeholder needs. Oh yes, I see lots more responses loading here. This is excellent. Thanks everyone for the input. Okay, so I see some similar things. Attracting investments, that's a good point as well. Complying with local reporting requirements and ensuring disclosure of material information to all relevant stakeholders. Understanding what the standards come in place from an insurance perspective. Looking for funding opportunities. Brilliant. And attracting investors. So lots of being a responsible corporate global citizen. I think that's a lovely one to finish on there as a good point that we should, of course, keep in mind with all of this, as long as those business benefits as well. Thanks, everyone. Okay, lots of fantastic responses. And I think that really shows, as we'd hoped, that we're thinking about this as more than just a compliance or a box ticking exercise, perhaps. Of course, being compliant with reporting requirements is essential here, but indeed thinking about what you can really gain from this disclosure internally and with your audiences in terms of investors and the benefits that may bring. And the intrinsic value in being transparent is fantastic as well. So thanks for sharing all of those options. So I think you've kind of covered everything that we think there. Perhaps a couple more tips to mention would be around also making sure that when you're setting out these objectives, you're looking to the future as well. So not just thinking about what you might need to comply with now or what your investors currently want, but doing your best to sort of horizon scan for where you expect that may move in the future, so that you're kind of building your resilience and longer term plans to provide that information as well. Great, thanks everyone for sharing those. So I will take us back to the slide presentation now, and I'll hand back over to Bella again for our next segment. Thanks, Bella.
Thank you, Fiona. Okay, let's move on. Okay, so now that we have introduced the initial concepts, let's dive into how to apply the SSB standards, taking into account additional disclosures, including any relevant geographical or sectoral requirements, as well as peer practices and your leadership's objectives. Okay, in order to understand how to ensure your disclosures meet global standards, we will look at two key concepts in this unit. The first and the main focus of this unit will be on how to apply the standards to achieve a global baseline for disclosure. Once we cover that, we will also discuss how additional disclosure fit. And to begin with, let's focus first on how to apply the SSB standards as the global baseline. Okay, let's get started on the first core content area, which is governance. This includes aspects that relate to the governance body in your company and how management is applied. Okay. For each of the core content areas, we will discuss questions that you could ask in your company to start identifying the information that will support some of the disclosure requirements. For example, as part of a gap analysis. So if we look at the governance and the management requirements, we can see that there are several that are fairly qualitative. For example, which bodies are responsible for the oversight and management of processes, controls, and procedures of sustainability-related risks and opportunities. For example, is management responsibility delegated to a specific role or committee? And also we can consider how and when do they get informed about sustainability-related risks and opportunities. How these issues inform strategy, decision-making, and risk management. This could include setting targets to manage sustainability-related risks and opportunities. And also, you can think of questions like whether progress against these targets links to executive remuneration. For more information, you can make use of the SSE checklist tool, but remember it's not a replacement for reading and using the full SSB standards. So now let's take a look at a couple of examples. Okay, over to you, Louise.
Thanks, Bella. Yes, the first example comes from a company called AIB, which is a high street bank in Ireland, and it comes from their 2022 annual report. And what you see here is a disclosure showing how sustainability-related risks and opportunities are governed within the company's existing governance model. So in the governance model example we see here, there are 3 board committees, the Board Risk Committee, Sustainable Business Advisory Committee, and the Board Audit Committee. And this broadly represents a kind of what's often described as the 3 lines of defense model, where we see how the governance is managed through operational aspects of the business, risk and compliance and oversight aspects of the business, and also independent assurance, both external and through internal audit. So there's a clear demarcation between these 3 responsibilities: audit, risk, and responsibility. Now, this is just one way of managing the governance aspects of sustainability. There are many other, but this gives you an indication of how responsibility is split across these 3 aspects of the company's business. And you can see that there's an executive committee that reports to the main board committees, and they in turn are supported by management and subcommittees. Let's look at another example, and this example comes from Toyota. It's Toyota being a large car manufacturer, as I'm sure you all know, and it's from their 2023 data book. Now, the way this is presented, this particular disclosure, is based on the recommendations of the TCFD, and that's why it's presented this way. But what it's telling us here is exactly what the role of the board is. So their deliberation, supervisory and monitoring duties, what the board has done to inform strategy. So we can see that they are actively involved in the formulation of long-term strategy, including the Toyota Environmental Challenge. So they're very much forward-looking as well. And importantly, we can see what actions have been taken by the board. So they're actually recording in their disclosures the decisions that have been made at board meetings, in this case held in 2022. So they've reported on and approved the identification of carbon neutrality as a key matter in relation to climate change, and they have approved the development of a plan to transition to carbon neutrality by 2050, and they've also approved investment in battery-related technology to support their transition planning. So, hand over now to Fiona to take us through the core content matter strategy.
Great, thanks so much for that, Lois. So with those examples hopefully making governance fairly clear, we're going to look next at the next core content area of strategy. So this often has a few more disclosures to include than governance, but it's really where companies can see the benefits from sustainability-related risks and opportunity management as well. So as you can see here, there are 3 high-level areas that we're going to focus on in the strategy content area. These are risks and opportunities, effects, and resilience. So we'll review each of these separately now. So the IFRS S1 and S2 disclosure requirements on strategy are designed to enable users of general purpose financial reports to understand a company's strategy for managing sustainability-related risks and opportunities. So if we first look at requirements relating to sustainability-related risks and opportunities, these are some of the questions you'll want to be asking internally. So when we're disclosing information about risks, information required includes a description of the effects, the time horizons under which those effects are expected, keeping in mind that the financial effects can occur before the risk or opportunity materializes, or after, or indeed change over time, as we talked about when we introduced risks earlier. And the last 2 questions on this list in particular look at climate. So this aligns with the requirements from S2. So for example, investors also want to understand what types of risks and opportunity they often want companies to look at. And some of these may often have been identified through TCFD reporting as well. So for example, physical and transitional climate risks. And both the S1 and S2 standards include guidance to support companies to identify and disclose risks and opportunities, for example, using industry-based guidance and the SASB standards. So again, we know this is something that's often easier to understand with an example in mind. So let's take another look at some practice here. So this example we have here is from Gold Fields, which is a diversified gold producer with mines in South Africa, Australia, Ghana, Chile, and Peru. So in the extract on the slide, we can see which risks the company has identified and how they have identified them using a prioritization matrix, how the risk aligns with their strategic priorities, and what mitigation policies the company is using. And there's then lots more information within their report about these individual risks. But I think what's great to see here is that they're really connecting these risks to their overall strategic priorities. They're showing their relative significance, and we're also showing how they plan to prioritize mitigation efforts as well. So this is a good example of that connectivity between strategy, risks, and mitigation. And another aspect of the risks and opportunities identified as having a potential financial effect that you'll need to disclose brings us back to what we were talking about at the beginning, that concept of time horizons. So you might remember we discussed earlier that the time can be quite a different factor when we're talking about sustainability-related risks and opportunities. So let's make sure we're clear on what we mean by time horizons. So the standards ask you to identify within what time horizon any material effects are expected to occur. And definitions of what are short, medium, and long-term horizons may vary between companies, and they'll depend on a number of factors. So for example, what are your investment and business planning cycles? What are your overall strategic planning horizons? The life of your assets, and other factors such as the assessment periods your investors are using as well. So what's important to remember here is that the time horizon should be defined. So don't expect that investors will necessarily know what you mean by short or medium term. You need to provide them with that definition. But really thinking about those different time horizons is a key aspect of considering these sustainability risks and opportunities. So moving on to the second group of disclosures in the strategy section. So here we're talking around the expected effects on the company's prospects of these risks and opportunities. And this is thinking about what those effects are exactly and where they occur within your business. So to start tackling the disclosure requirements on this aspect, companies will want to think about the questions relating to describing those effects, understanding the responses that they plan for, mitigating or adapting to them. And again, an example hopefully will help to bring this to life a little. So this example comes from BASF, which is a global chemicals company. So the company acknowledge in their disclosure here that their strategy is closely affected by changing climate, by scarcity of natural resources, pressures on ecosystems, and a growing population. And as we talked about in the first set of disclosures on strategy, they were able to show which risks and opportunities they expect to affect their company. And then furthermore here, they explain those effects. So they say that their business in the chemical sector has a key role to play in addressing the challenges they've identified, thinking about things such as innovation, through using raw materials more efficiently, reducing waste, enabling healthy food production, and also climate smart mobility. So as well as the changes they're hoping that chemicals can offer society to respond to some of these macro trends, the company itself is also going to undergo some profound changes potentially. And these transformations will need to occur along its value chain. So as shown in the excerpt we include here, where we can see they start to think about the different value chain aspects that would be involved in these financial effects, thinking about how their production and their different products would be affected as well. So this is just a small summary from their report, but we'd encourage you to look at the detail as well, which gives more information on these things. So sometimes one of the obstacles we know that companies face when they're reporting on these effects is what detail they should be disclosing. And in the example we just looked at there, we were showing mostly qualitative disclosures and descriptions. But what about quantitative information? So a company is expected to disclose both quantitative and qualitative information about current and anticipated financial effects relating to those sustainability risks and opportunities. However, the ISSB standards do also set out criteria for when only qualitative information is required. So using only qualitative information for current and anticipated financial effects is permitted for a number of reasons. So either if a company can't separate the effects of a climate-related risk or opportunity from other effects, or if there is a high level of measurement uncertainty. And additionally, only qualitative information for anticipated financial effects is permitted if the company doesn't currently have the skills, capabilities, or resources to provide that quantitative information. So that brings us now to the last strategy aspect that we're going to talk about. So of course, we've talked about looking at what those risks and opportunities are that will affect the company. We've then looked at disclosing what the financial effects of those risks and opportunities are. And now here we're thinking about preparing for uncertainties and ensuring resilience for the future. And this really gets into the practices and processes that a company has in place to assess its resilience and to make strategic adjustments where it needs to. So disclosures will include information on what types of assessments have been used and how scenario analysis has been employed as well. So at the heart of it, resilience disclosure requirements ask the company to think about its assessment of climate resilience and the inputs and key assumptions that have been used in this analysis. So we're going to dive a bit deeper into scenario analysis in a moment. But some of the questions you could consider asking internally to get started here will be around thinking what the company's fundamental capacity to adjust or react is to uncertainties, and how different scenarios might be used to test this further. So again, we've got a couple of examples here that we hope may help. So firstly, we'll start with Stora Enso, which is a Finnish and Swedish forests product company. And they show us in this diagram on the top right here what they project that their sales may look like in 2030. And they distinguish between their growth businesses relating to more sustainable products that they're going to be shifting to, and their other or the more conventional business areas at present. So there aren't any numbers obviously shown on this kind of financial effect figure at the moment in this disclosure, but we do already have an immediate picture of where they're anticipating to see growth. And we also have detail in the text about their long-term vision and their recent efforts to transition to what they describe as proactively repositioning the business from a forest, paper, and pulp company to a renewable materials company, and in doing so, aiming to ensure their future. So this gives us a sense of how they're really looking to grow, to transition what they already do, and acquire new businesses as well that will help them to achieve this vision. And our second example here is from Solvay, which is a Belgian multinational chemicals company. And here we're using this example to consider the illustration that they give of financial effects. And in particular, we want to highlight how they're being transparent about the estimates that they use, and note that they have developed about scenario analysis. So, of course, scenario analysis can be a very helpful tool to use when estimating anticipated financial effects, although there are other methods that you could use for this as well. So if you are looking to use tools like scenario analysis, investors will need to understand how you've used them. So in this excerpt, Solvay note what assumptions they've used, and they indicate which scenarios they've considered as well, the different business units that they've focused on, and they also highlight the internal experts they've drawn upon and the work they've done with a consultancy to support them on this. So it's good to see this transparency about how they've arrived at the conclusions that they're giving regarding the financial effects. And you can also see on the bottom half of the screen that they've provided some conclusions for their scenario analysis for different business areas. So I'll leave you to read that because it's in your own time if you look at the handout, because the text is a bit small. But fundamentally, they're looking at factors such as how the prices of raw materials might change, how energy efficiency could affect their profitability, and how different aspects of their business might expect to see either growth or contraction of sales in different scenarios. So it's useful to see that they have made efforts to quantify this information, whilst also putting some useful caveats around areas of uncertainty as well. Okay, so that brings us to that element conclusions there. But what we'll do now is just do another quick poll with you all on this section. So our question here is a multiple choice one again. So the question is, a company may choose to disclose only qualitative information and/or combined quantitative information about current and anticipated financial effects when, and you need to pick which of these you think is an acceptable response. So when the company can't separate the effects of a climate-related risk opportunity from other effects, when there is a high level of measurement uncertainty, or when the quantitative information sheds a negative light on the company. So you can pick more than one correct answer, but I'll just give you all a moment to let us know which of those you think would be valid reasons for disclosing only qualitative information or a mix of quantitative and qualitative. Okay, I see steady trickle of responses coming in. I see about a third of you have voted so far, so let's give it another moment. Just have a think about those options. Okay, we'll try and get us up to 50% participation, just a couple more people to respond to get us to that. And we get there. Set the target now. We're at 48%, 49%. There we go. Hey, great. Let's go with 50% then, and we'll end the poll there, share those results. So yeah, the majority of you have got that correct. The first two are, of course, the reasons that we discussed, that a company may not disclose quantitative information. So either if they can't separate those effects out, if there's a high level of uncertainty. And we also gave a third reason relating to the skills, resources, and capabilities of the organisation to provide that information. But as the majority of you correctly guessed, the last option is not considered a valid reason not to disclose quantitative information. So of course, we need to be providing balance in our reporting here and showing not just the positive potential financial effects or opportunities, but also if you expect to see material negative financial effects, that's very important information to disclose to your investors. And as we saw in that example from Solvay just before, that is indeed something that they are doing in their reporting, disclosing potential reductions in profitability as well as areas where they might grow. Okay, great. Thanks everyone for taking part in that. So that brings us to the next segment, which Lois is going to be taking us through.
Thank you, Fiona. And in this section, we're going to be looking at the climate-specific considerations that apply to the core component of strategy that Fiona's been explaining. So the governance requirements in S1 general requirements and S2 climate requirements are very similar. They both ask about how what the composition of the board is and what types of decisions they make, how they monitor and oversee sustainability and climate considerations. But when we look at strategy, which is the core component with the most requirements, there are some additional and very specific requirements that relate to climate. And funnily enough, I just saw in the Q&A someone has asked a question about that. So that was very good timing from the questioner. So let's have a look at some of these climate-specific considerations. Now, the title of this slide is From TCFD to ISSB, and partly what we're trying to do here is to explain how the ISSB is the same as or differs from TCFD. But if you are not familiar with TCFD, you can look at this as a list of requirements that apply specifically to climate change in the context of the strategy core component of the requirements. So for strategy, the IFRS S2 on climate requires a company to refer to and consider the applicability of industry-based topics. So there's if you actually look at S2, there's no substitute for looking at the requirements themselves. You will see that there is frequent reference to industry-based topics. Now, these can be found in a document that's separate from IFRS S2, and it's called Industry-Based Guidance on Implementing IFRS S2. And what it means is that companies, when preparing their climate disclosures, look to this industry-based guidance for finding the topics and metrics that are most suitable for their particular industry. And as the questioner asked earlier, yes, they are based on the standards of the Sustainability Accounting Standards Board. The second thing to note, the second bullet point, is that IFRS S2 requires detailed information on where in the business model and value chain risks and opportunities are concentrated. So is it at a particular location, in a particular production process? Where is the risk or opportunity concentrated? Thirdly, S2 asks for details on the effects of climate-related risks and opportunities and how the company responds to those particular effects. Next, it asks, the S2 sets out criteria for when quantitative and qualitative information is required for the disclosure of current and anticipated financial effects of climate change. So disclosure of qualitative information is permitted under some circumstances, for example, when a company cannot separately identify the effect of a risk or opportunity, or when the level of measurement uncertainty is so high that the information would not be decision useful. we're going to look at this next point in some detail, and that is that S2 requires the use of all reasonable and supportable information available at the reporting date without undue cost or effort, and the use of an approach that is commensurate with the company's circumstances. This particular easement, as we might call it, is used for specific requirements and recognizes that some of this information can be very new to a company, or the data may not be available or may not be of sufficient quality, and therefore the company is required only to use reasonable and supportable information available to it. We talked a little bit already about scenario analysis. S2 does require companies to use climate-related scenario analysis in order to assess its resilience to climate-related risk. But the standard does not specify the particular scenario that is to be used. That is for management to decide. And finally, this requirement for the company to assess its resilience does have particular information that must be supplied, including which significant areas of uncertainty have been considered by the company when making its resilience assessment. What is the company's capacity to adjust and adapt its strategy and business model over time in response to risks and opportunities, and also details of how and when climate scenario analysis was carried out, and of course, which scenarios were used. Let's have a look now at one of the specific aspects of IFRS S2 on climate. So S2 requires a company to disclose details of any climate-related transition plan it might have. Now, there's no requirement in the ISSB standards for a company to have a climate transition plan, but if it does, it must disclose details about it. So what are those? First of all, what is a transition plan? Well, the standard defines a transition plan as being an aspect of the company's overall strategy that includes targets, actions, or resources for the transition towards a net zero economy, including, for example, greenhouse gas emissions reductions plans. So as it is an aspect of the company's overall strategy, the transition plan should be aligned internally with the company's wider strategy, including the business case and motivation for transition, and the levers that the company's strategy is most suited for using in order to decarbonize. The transition plan could also be aligned externally with the goals of science, including what science says about requirements for net zero to be achieved, any net zero pledges, climate neutrality goals, Paris-aligned commitments. These can all be explained in terms of science and scenarios, and therefore the transition plan may be aligned externally with the science. The plan must also include long-term transition goals supported by activities and targets to achieve those goals, and interim targets as well, and milestones to monitor progress towards that long-term transition. There, of course, with any transition plan, there will be uncertainty surrounding it in terms of, what can be achieved. So the plan should be transparent about the dependencies for the plan's progress and success, the risks and challenges of executing the plan and implementing it, and how residual and unabated greenhouse gas emissions will be treated. Of course, the transition will proceed in different ways for different sectors and industries, and therefore sector-specific pathways that are published by various organisations could inform the development of the company's transition plan, and we're going to look at some resources available for that in a moment. And finally, companies should consider how the transition plan will be evaluated by investors and others, and ensure it has the hallmarks of credibility. And those hallmarks are published by various organisations, and we'll have a look at some of them now. So here's a snapshot of some of the resources that can help with transition plans and transition planning. Bear in mind, there are lots of resources. Now, on the in the triangle on the left-hand side of the screen, you'll see the IFRS Foundation at the bottom, the work of the GFANZ, which is the Glasgow Financial Alliance for Net Zero, in the middle, and the work of the Transition Plan Task Force at the top. We're going to look at those resources in a moment, but what this triangle tells us is that although there are lots of these resources, they originate from 3 different organisations, they're all designed to work with each other and to be complementary and to help with the process of transition plans. In the middle, 3 little thumbnails here, we see the work issued by the GFANZ, the Glasgow Financial Alliance for Net Zero, and these are publications that set out the expectations for real economy transition plans, financial institution net zero transition plans. And as I mentioned earlier, here we can see some sectoral pathways for financial institutions. On the right-hand side of the screen, we see the Transition Plan Task Force Disclosure Framework. Now, as I said at the beginning, when we looked at the evolution of the task force, this is the framework that has now been taken over by the IFRS Foundation. So it will inform their work on how to develop transition plan disclosure requirements and guidance as part of the IFRS Foundation's work. So plenty of resources. There are many more than this to help you. Now, at this point, you'll be glad to hear we're going to have a quick break, just a 5-minute break. So during the break, have a stretch, a drink. Feel free to keep asking us your questions in the Q&A. We're going to play you some nice music and we'll see you back here in 5 minutes. Hello again, everybody, and welcome back to this webinar. Hope you had a good break. We're going to turn now to the third core content component of the standards. We've covered governance and strategy, and we're moving on to risk now. So the risk management core component asks for information about the processes for risk that are used by the company for risk management and whether they are integrated into the company's overall risk management profile and processes. So a slightly different type of requirement here, whereas the requirements we've looked at so far ask for information, for decisions and conclusions and plans. This particular core component asks for details about the processes that companies use to identify, assess, prioritize, and monitor their sustainability-related risks and opportunities. And the focus here is on those risks and opportunities that could reasonably be expected to affect a company's prospects over the short, medium, and long term. So a company is required to disclose information about these processes and policies. So you might start asking yourself internally about what sort of inputs and parameters are used for risk management, what kind of processes you already have in place in the company, whether and how sustainability related risks and opportunities are prioritized, how the nature, likelihood, and magnitude of risks and opportunities are assessed, what criteria are used for that assessment, how risks and opportunities are monitored, and whether and how processes have changed since the last reporting period and whether your disclosures need to reflect that. And of course, importantly, for those of you that are familiar with integrated reporting, you'll be familiar with this, how those processes have been integrated into the company's overall risk management process. So how sustainability risk relates to the overall risk management process. Now, as we said before, there are differences between IFRS S1 on the strategy, and similarly, we have slight differences in the climate standard on risk management. They're not differences so much, they are additional requirements that pertain specifically to risk management. So, the disclosure requirements in IFRS S2 are broadly consistent with the TCFDs, except that IFRS S2 wants more information about input parameters used to identify risks. Now, although scenario analysis is primarily to be used for assessing the resilience of the company's strategy and business model to climate risks, the scenario analysis can also be used to inform risk identification, and that should be disclosed if it has been. And disclosures should also be made about whether the risk management processes have changed over time. There are also disclosures required on the processes used to identify, assess, and prioritize and monitor climate-related and sustainability-related opportunities, and also how this is integrated into the company's overall risk management processes. So in IFRS S2, we do have a definition of climate-related risks. So for the purposes of identifying climate-related risks, you have the definition that we'll go through now. Now, broadly, the risks are separated into two types. There are transition risks, and these arise from efforts to transition to a lower carbon economy. And in turn, they are often categorized as being policy and legal risks, technological, market, and reputational risks. In the middle of the screen, we can see some examples of these. So transition risks could include increased pricing of GHG emissions, more reporting obligations, exposure to litigation, we see more of that now, costs associated with transition, and changing customer behavior and uncertainty in market signals, and so on. So in all cases, as we see in the final column here, these types of risks can have financial effects. The second type of transition risk in the first column at the bottom are physical risks. So these include risks from climate change that can be event-driven, and these are acute physical risks associated with weather-related events such as storms, floods, drought, and heat waves, which are increasing in severity and frequency, or they can be from longer-term climatic patterns. These are known as chronic physical risks. So they include changes in rainfall, temperature, sea level rise, reduced water availability, biodiversity loss, and changes in soil productivity. You can see some examples in the middle there about changing weather patterns. And again, these types of risks can have financial effects on affecting cash flows, access to finance, cost of capital. And those financial effects can be felt over different time horizons, the short, medium, and long term. Similarly, in IFRS S2, we have a definition of what is meant by climate-related opportunities. Generally, these refer to the potential positive effects arising from climate change for a company. And these opportunities can arise from efforts to mitigate and adapt to climate change, and can include things like innovation, better resource efficiency, use of lower emissions energy sources, development of products and services that satisfy consumer demand for more climate-friendly products, and identification of new markets and increasing your company's resilience to climate risk by using these opportunities. You can see some examples in the middle, some of which I've already mentioned: gaining access to new markets, differentiating yourself from competitors, being able to substitute resources and diversify activities and resources to enhance these opportunities. Again, these opportunities are likely to have financial effects, hopefully to improve cash flows, improve access to finance and cost of capital, and those financial effects will manifest over different timeframes. We're going to look now at an example from NATS, which is the UK's domestic and North Atlantic air traffic control service provider. And this is an example about the way in which they identify and manage climate-related risks and opportunities, and it comes from their 5-year transition plan. So many of us know that bad weather already causes delays for airlines, airports, and passengers, and actually this can lead to increased CO2 emissions due to aircraft circling or being held in different patterns or diverted, and airspace becomes congested and inefficient. And what NATS has done in this 5-year plan is that they've looked at current and acute risks and impacts that have been caused by weather in 2019. So they look at the financial effect of major storms. They look also at the way in which bad weather has forced them to fly extra miles, to burn extra fuel, to emit more carbon dioxide. Turning to the middle section of this example, the company then looks at how the weather is predicted to change in 2050 and what that effect that will have on air traffic. And they expect this to mean that air traffic flow management will worsen by 0.5%. And that translates into an extra 57,000 tons of carbon dioxide emissions a year. They also look at the bottom of that middle panel at acute physical risks in terms of coastal and low-lying airports being at risk of flooding. So they also look at the very end panel, I won't go through this in detail, at the outcome of these changes and how they could be positive in some respects, but they need a strategy to determine how to respond to those risks and opportunities that they have analysed. So Bella now is going to take us through the final core component, metrics and targets.
Thank you, Lois. So as Lois just mentioned, we will now spend some time reviewing the disclosure requirements on metrics and targets in more detail, the final core content area of the standards. So let's start with metrics. Requirements on metrics are designed to enable investors to understand a company's performance in relation to its sustainability-related risks and opportunities. Preparers shall disclose information explaining how the metrics are defined, if they are absolute or relative, if they have been validated by a third party, as well as the methodology, what is the method of calculation, what were the inputs, are there limitations, and what assumptions are involved. So these are all questions you need to be considered when to evaluate or to prepare some information about metrics. Okay, now let's move on to the second part of this category, targets. Requirements on targets are designed to enable investors to understand the targets a company has set to monitor progress towards achieving its strategic goals. Disclosures include whether they are qualitative or quantitative, and whether it is set voluntarily or by law or regulation. And the metric used to set the target and to monitor progress toward its achievement. And also disclosures include the baseline period from which progress is measured and the period to which the target applies. And also what are the milestones and the interim targets, if there have been any revisions to the target, together with an explanation about the revisions. Okay, so after an introduction, let's look at an example. And I'm going to hand over to Lois for the example.
Thank you, Bella. And here we have an example from ArcelorMittal's 2022 annual report. So bear in mind, this was published before the ISSB standards. So ArcelorMittal is a multinational steel manufacturing and mining corporation. And what we want to, why you want to show you this example is to give you some inspiration on disclosures about metrics and targets. So the first thing to notice about this example is that the company sets out its ambition. Its ambition is to have a leadership position within the steel industry and to achieve net zero steelmaking globally by 2050. So this sets the context, the leadership ambition context, for what you might expect to see in the metrics and targets to support that ambition. They set out their targets, which are to reduce the carbon intensity by 25% globally and 35% in Europe by 2030. So that's an interim target leading up to 2050. They tell us the scope of the target. So the scope of the target covers both scopes 1 and 2 greenhouse gas emissions for steel and mining per ton of crude steel. Sorry, we just lost, I think, some of the, what page were we on, 18? Oh, I'll take you back to where we are. I don't know if this is happening on your screen as well. Here we are. We're back to ArcelorMittal's example. So in the middle there, we see the scope of the target. So we know what it covers. We know that this target is set in the context of a roadmap that the company defined in 2021, that is a roadmap for achieving medium-term targets to 2030 and the long-term target to 2050. What we also see here is the metric $10 billion, which is the investment, the anticipated gross investment in supporting these targets. On the right-hand side of the screen, I won't go through this, but the company sets out the assumptions behind its targets, but also the dependencies for success, including things like a supportive regulatory framework, supportive policy making. So quite a lot of inspiration in the example there from ArcelorMittal, and I'll hand you back now to Bella.
Thanks, Lois. Okay, so let's move on. Yeah, now let's talk about some of the climate-specific considerations for disclosures on metrics and targets. The TCFD framework included recommended disclosures, which IFRS S2 builds on and adds to as part of required disclosures. For example, IFRS S2 requires disclosure of industry-based metrics relevant to a company's business model and activities. And also additional disclosures are required on GHG emissions, including separate disclosures for the consolidated accounting group and the associated joint ventures, and information about the company's financed emissions. In addition, S2 sets out a Scope 3 measurement framework to provide guidance for preparing Scope 3 GHG emissions disclosures. While S2 doesn't explicitly require a company to disaggregate its GHG emissions disclosures by the constituent gases, IFRS S1 includes requirements on disaggregation that would result in the disclosure of the constituent gases being required if such disaggregation provides material information. I'd like to remind everyone that you can access more information on climate metrics in the ISSE's training tool on this topic. We will share the link in the chat, and you can also find it on the ISSE's website. Likewise, there are some additional disclosures compared to TCFD for targets as well. For example, IFRS S2 requires disclosures about how the latest international agreement on climate change has informed the target and whether the target has been validated by a third party. IFRS S2 also requires disclosure of more detailed information on GHG emissions targets, including additional information about any planned use of carbon credits to achieve a company's net GHG emissions targets. And S2 also includes additional requirements to disclose information about the approach to setting and reviewing each target, and how it monitors progress against each target, including whether the target was derived using a sectoral decarbonization approach. Okay, questions on GHG emissions often come up in the questions on metrics and targets disclosures. So we wanted to address some of these briefly. For those who might not be familiar with the different scopes, there are 3 types of scope, which is Scope 1 includes all direct emissions that occur from sources owned or controlled by the company, such as emissions from your company's facilities or vehicles. And also Scope 2 includes emissions from generation of acquired and consumed electricity, steam, heat, and cooling, such as the electricity you purchase. And finally, Scope 3 is then all other indirect emissions that occur in the company's value chain. So S2 also requires a company to disclose its absolute gross Scope 1, 2, 3 GHG emissions in accordance with the GHG Protocol corporate standard, unless a jurisdiction requires a company to use a different approach to measurement. If a company is using a different measurement method, there is a transition relief to use that method in its first year of applying the standard. Whether and how the company is using an internal price on carbon for decision-making is also required to disclose. And finally, whether and how executive remuneration is linked to climate change. Okay, now it's time for example. So over to you, Lois.
Thanks, Bella. And here we have an example from a company called Enel. It's from their 2022 sustainability report. And Enel is an Italian producer and distributor of electricity, of gas. And this is an example that shows one of the ways in which Enel disaggregates and explains its greenhouse gas emissions. It's just an extract. There's a lot more information in their reports, including their more current ones. So at the top of the page, you see the title, Our Carbon Footprint, and it's broken down into scopes 1, 2, and 3 greenhouse gas emissions. But it also shows the trend across 2021, which is in the light green bars, and 2022 in the dark green bars. So in this little extract at the top of the page under our carbon footprint, you can see the split of emissions across scope 1, 2, and 3, and you can also see the trend across different years. At the bottom of the page, you can see the greenhouse gas emissions broken down by source. So you can see the various business lines, generation, trading, networks, end customers, and you can see the scope 1 emissions broken down between these sources. So it's immediately obvious from the graph bars, the light and dark green graph bars, that the majority of scope 1 greenhouse gas emissions come from generation from thermal sources, that is from the combustion of fuels in generation activities. There's some more detail in this diagram at the bottom. You can see there's little numbers 1 to 6 on the diagram, and these refer us to notes, narrative notes, where we can see more information. So for example, note 1 tells us that the majority of the scope 1 greenhouse gas emissions came from particular gases, including methane and N2O. The little dots, you can see little coloured dots as well. These refer to whether and to what extent the greenhouse gas emission source is considered within a science-based targets initiative. So in this one little diagram, you can see what the breakdown of emissions is across years, across scopes, across business lines, and what is the composition of those greenhouse gas emissions and whether the company has targets to reduce them. Let's go now to a Zoom poll. And the Zoom poll asks you, what is the objective of metrics? That is, what is the objectives of the metrics requirements in the ISSB standards? You can have multiple choice answers here. The objective is to understand the company's performance in relation to the entity's sustainability-related risks and opportunities, to understand progress towards any targets, or to understand the company's assumptions for the future. Give you a moment to have a think about that. I can see a good level of participation and a pattern, so I shall end the poll in the interests of time with many thanks to you for participating and share the results. So the A and B are the correct answers: to understand the company's performance in relation to sustainability-related risks and opportunities, and to understand progress. Now, the third answer is not necessarily incorrect. The metrics might well help a reader understand the company's assumptions for the future if the metrics are presented in that way. But the reason we've asked you the question in this way is to express the importance of looking at the standard itself if you can. So at the beginning of each one of the requirements, you will see that the standard sets out the objective. So in the case of the metrics and targets objective, if you look at paragraph 45 of IFRS S1, it says the objective of sustainability-related financial disclosures on metrics and targets is to enable users of general purpose financial reports to understand an entity's performance in relation to its sustainability related risks and opportunities, including progress towards any targets the entity has set and any targets it's required to meet by law or regulation. So, of course, management is free to provide metrics that help the reader understand the company's assumptions for the future, and there's nothing wrong with that. But we just wanted to impress upon you that each requirement has an objective set out at the beginning, and that might help you to determine the best way to approach your disclosures. So we're going to move on now to the next part of the Align module. And this part is about how you integrate the ISSB disclosure requirements with other requirements that the company may be required to or choose to comply with. So it's the final section of the Align unit. Now, earlier, we talked about the global baseline and how jurisdictions and others can add to the global baseline, which is reflected in the standards. So what could you do to build on the baseline, or what could jurisdictions and others do? Well, they could refer to voluntary or mandatory requirements in their jurisdictions, such as listing requirements. And those listing requirements might also apply to companies in your supply chains. So you should be prepared to provide information necessary to support your procurers or suppliers. You could build on, or the baseline can be built on by reference to policy objectives. So governments in particular jurisdictions may offer incentives like tax cuts or subsidies to support sustainable practices, or they might have disincentives for activities that are counter to national objectives. What we build on the baseline might also be reflect industry standards. So what particular sector pathways or industry expectations there are of different industries, particularly high emitting industries where climate change is concerned. And of course, the baseline may be built upon by adding information requirements that satisfy the needs of other stakeholders for more comprehensive disclosure practice. So as you know, the ISSB standards are implemented in jurisdictions through a process that is conducted within the jurisdiction. So there is jurisdictional progress towards the adoption or other use of ISSB standards, so it can be voluntary or mandatory. There are more than 20 jurisdictions that have already committed to introducing the ISSB standards, and the foundation gives dedicated support to jurisdictions as part of its regulatory implementation program. We've given you a link there to completed and ongoing jurisdiction consultations about adoption or use of the IFRS standards in different countries. So do have a look at that if it is of interest. So, of course, as the ISSB standards become adopted and used around the world, we saw earlier that this happens within a context of existing standards. We saw this when we looked at the landscape. So what happens with voluntary standards? Well, these voluntary standards, as we saw earlier, are aligning with the global baseline set by the ISSB. So CDP uses IFRS S2 as the foundational baseline for its climate disclosure questionnaire. Some of you may be familiar with the greenhouse gas protocol. It's the corporate standard is required to be used for the measurement of greenhouse gas emissions in the ISSB standards. And to ensure interoperability, working together, making things seamless and harmonized, the ISSB is actively involved in updates to the GHG protocol standard. We'll go into the relationship with the GRI in a moment, but they're working to align their standards as far as possible. we've seen that the IFRS Foundation has taken over responsibility for disclosure-specific materials of the Transition Plan Task Force. And in its current work plan, the ISSB is looking at nature-related financial disclosures and considering how the work of the task force on nature-related financial disclosure might inform its work. Let's have a little bit of a deeper look at the ISSB and GRI. We saw earlier that some of you are using GRI. So the IFRS Foundation and GRI are looking at ensuring the maximum interoperability between their standards. They're trying to jointly identify and align common disclosures. The thumbnail you see on the left is an analysis that was published by GRI and ISSB on mapping disclosure requirements on scope 1, 2, and 3, and found there to be a lot of similarities. And there's a collaboration between the organisations to deliver full interoperability, starting with GRI's biodiversity standard and the project I just mentioned, the ISSB's work on biodiversity, ecosystems, ecosystem services, nature-related disclosures. And to sort of seal the relationship, make it closer, the IFRS Foundation is a convening partner of GRI's Sustainability Innovation Lab in Singapore. So the other thing, maybe not quite so relevant to this audience, but I'll mention it because it's important. As you all know, in Europe, the EU has introduced various pieces of law that require sustainability-related reporting, in particular the corporate reporting, the Corporate Sustainability Reporting Directive. Now, the standards to support that directive are known as European Sustainability Reporting Standards, or ESRS for short. Now, the ESRS are designed to meet the information needs of a wide range of stakeholders who are interested not only in sustainability-related risks and opportunities, but also impacts and dependencies. So there are some differences between the two organisations in terms of their focus and objectives, but they've done some work to map their standards on climate change. And you will see that the conclusion is that there's a high degree of alignment in relation to climate-related disclosures. And the two organisations, the European Standard Setter and the IFRS Foundation, continue to work closely together to ensure the maximum degree of alignment between their standards. Let's look now at something possibly more relevant to this audience, which is how the integrated reporting framework supports the ISSB's work. Well, as you know, the integrated reporting framework provides principles-based guidance for reporting content and structure. And the integrated reporting framework is a complementary tool that goes together with S1 and S2, both integrated reporting and ISSB work focused on investor-focused communications. So the document you see on the left might be of interest. It explains how to get started with transitioning between integrated reporting and reporting to the ISSB. It explains how integrated reporting can support a holistic view of the value creation process within companies and provide a more complete picture of how value is created over time. You'll see some guidance within the document that the picture of which you see on the front there. It includes dedicated frequently asked questions on integrated reporting, a mapping tool, a getting started guide. But perhaps the most important thing to mention here is that, as you know, integrated reporting is underpinned by integrated thinking, and that very much can enhance the quality of a company's governance strategy, risk management, and their disclosures. So let's look now at a poll. So the poll asks, about what your disclosure objectives should consider. When considering your disclosures and their objectives, should you consider the ISSB standards only? Bear in mind, this is a single choice question here. You can answer only one. So do you consider ISSB only, the ISSB standards and regulatory requirements, just regulatory requirements, or all of the above and other sources of guidance as necessary? You're all responding really fast to this one, and there's a very clear pattern emerging. So in the interests of time, now that we're at 50%, I'll end the poll and share the results. Of course, you're right. You should consider the ISSB standards, regulatory requirements, and other sources of guidance that help you to conform with the requirements and with management's decisions about what they want to communicate to their audiences. I think we might have another Zoom poll now. Let's just see. No, we don't. We're going to Fiona now for a summary of Module 2.
Great, thank you, Lois. Brilliant. So that, as Lois says, brings us to the closing point of Module 2, which we know has been quite a large one. So thank you for staying with us. But of course, there's a lot to cover in this area. But just to recap on a few of the key things to take away from this module, we reviewed all the 4 different core content areas of the ISSB standards. That's governance, strategy, risk management, and metrics and targets. But an important thing to remember here is that these don't operate in silos. We saw in our examples that despite having 4 separate categories of disclosure, in practice, these are often very much interconnected. And that's something, of course, that needs to be addressed and grappled with in the reporting itself. And we also discussed how your disclosures might go beyond the requirements of S1 and S2, for example, to meet different stakeholder needs, to meet regulatory requirements in certain jurisdictions, or to meet industry standards as well. And what's important to remember when you're doing this is that the ISSB standards have been purposely developed to act as a baseline. And the building blocks approach allows report preparers to add additional disclosures on top. But in doing so, of course, report preparers do need to be careful not to obscure the requirements of S1 and S2. So to close off this section, we just have a brief exercise on the alignment side to reflect on. We are aware you've probably thought a lot about the different content areas that we've been talking about as you've moved along, and maybe are starting to get a sense of where some of your key gaps are. And so what are the key gaps really that you might need to address is an important question to reflect on as you're planning your approach. So keep thinking about how to go about this could include, of course, conducting a gap analysis, using that checklist of the SSEs that we mentioned to you before, perhaps as an informant to that, and starting to think about what enhancements or additions to your reporting may be needed to align to these requirements. And that might be enhancements in terms of new topics to look at. Perhaps you need new processes internally to collect different types of information, or maybe you even need to think about new skill sets and resources that you could need to support you. So we'd like to take a moment for you to just think about what some of those gaps could be, what's front of mind for you as something that you may need to take forward. And of course, we recognise that you'll want to probably take this away and do a more structured assessment, but this is just to get you thinking initially about, any reflections you may have at this stage. Okay, so thank you to everyone who's already taken part in this already. So someone just says, just starting will be good enough. There is information here and there, but it needs to be out together. I think that's a good point, actually. Often we can get a bit stuck on figuring out what we're doing and how to do it. And sometimes the easiest way to understand what we need to do is just to give it a go, and we'll learn through that. So I think actually that's a nice point to reflect on there. We also have someone mentioning that they think their key gap is around governance of the sustainability process, so strategy development, execution, and monitoring. Perhaps you have seen also knowledge and skills gap in your leadership teams and executives. So speaking to them and engaging them early so that they understand, that point we said earlier about the objectives of this, the purpose of it, can be very helpful. Maybe methodology gaps, lacks of data or skills, team capacity. verification of data that would allow comparisons, metrics, lack of data, a lack of data collection frameworks causing the data. Of course, we recognize that often a lot of this information will be new to you. We hope that some of what we talked about earlier in terms of, starting perhaps with qualitative understanding of risks and opportunities initially, understanding, what data you would need to assess those quantitatively so you can build out an understanding aligned to material topics, of course, is really important as well. Understanding and support from leadership is mentioned again. Understanding fully what your organization does. Well, yeah, that's a very important point. I think it's very hard often for one team or individual or working group to have a full understanding of the remit. So bringing in the full span of knowledge that you really need to assess those different sustainability risks and opportunities can be a challenge for sure. So leadership knowledge, governance policies, identifying the core objective of sustainability reporting in financial services firms which don't necessarily deal with physical products and goods and services. Yes, of course. So some of those drivers and benefits that we discussed earlier will very much differ between a financial institution and a real economy organization. So translating that in a way that makes sense for you is a very good point. That might be about thinking about the underlying sectors that you're invested in and what risks and opportunities they're exposed to, or it may be looking to some of the financial sector specific resources that are out there to help with understanding that better as well. Okay, understanding local jurisdictional efforts, exactly, what do you need to align to? And obviously we've shared mention of the source you can check to look at jurisdictional consultations and where those are up to and get a sense of any particular requirements that those may bring in. Support from different departments, maybe more training. And yes, that gap around the financial effects, often we may have already identified sustainability risks, but quantifying those financial effects will likely be quite new. And an area, obviously, where we'd recommend that you draw strongly upon your financial teams to support you in that exercise. Okay, excellent. So I think we've had some good reflections there. So we appreciate we're not going to be able to solve all of those gaps for you in today's session, but hopefully it is helpful just to take a moment to reflect on what you think the key gap for you might be. We recognise, the maturity of processes is different between all organisations and different approaches. So taking a moment just to think in a systematic way about, what you might need to particularly prioritise is very important. So we notice, of course, that this is going to be something that will evolve over time. So making sure to start with, what you think is a key gap to address, whether that be data, as some people have mentioned, whether that be perhaps understanding and buy-in, and then building from there is obviously a really good approach. So encourage you to take the more detailed exercise that we have in the disclosure plan homework assignment as an input as well to help you build out thinking in this area further and to do that more structured gap analysis. But great to see those initial thoughts. Okay, brilliant. So I will take us back into the PowerPoint now and I'll hand over to Lois for our next segment.
Thank you, Fiona. So yes, we're now moving into the implement part of our webinar. Yes, the backbone of disclosure, we're looking at processes and practices. Funnily enough, I just saw a question in the Q&A about how to measure Scope 3 emissions. And this is what we're turning to now. As you've probably noticed, the standards themselves focus on what to report, but there's not so much information about how. However, if you look at the appendices to the standards, you will see some helpful application guidance. So there is some guidance, but we're going to look a bit more at how. We're going to look at three things in this module. How to identify sustainability related risks and opportunities, what is the evaluation process that you might apply, and how to integrate sustainability related risk and opportunity management and monitoring into your existing processes. So we'll start with how to identify sustainability related risks and opportunities. So first of all, IFRS S1, as you know, asks companies to provide material information on all sustainability-related risks and opportunities that could reasonably be expected to affect a company's prospects. And IFRS S2 says similar in relation to climate-related disclosures. So what about risks and opportunities beyond climate? At the moment, we only have S1 and S2. We don't have specific standards from the IFRS Foundation on other types of risks. So the standard says that to identify sustainability related risks and opportunities to report on beyond climate, S1 says that companies must consider the SASB standards, the standards of the Sustainability Accounting Standards Boards, and they're all available on the IFRS website. In addition, if they need to, companies can also consider other materials. So there's IFRS educational material on sustainability related risks and opportunities and disclosure of material information. That's quite new on their website. There's access to the CDSB framework application guidance that covers climate, natural capital and social and human rights issues. There is industry practice that companies might refer to, perhaps set by a sector body that the company belongs to, and the company can also consider materials of investor-focused standard setters, i.e. those standard setters that produce information for investor needs. So having decided that you can identify risks and opportunities using these materials, then to identify what to disclose, similarly, the company must consider SASB standards and can also consider the standards I went through before, but can also look to GRI standards and European sustainability reporting standards, who, as we said before, have work that is bigger in its scope and objectives. So we're going to have a look at an example now from a company called Yara, and Yara is an international global crop nutrition company. We're looking at an extract from their 2022 integrated report. And this is an example of how they identify risks and opportunities. You'll see at the top of the screen, they start with global macro trends that inform and influence Yara's particular market trends. So they look to things like population change, geopolitical and trade uncertainty. And these sorts of macro trends can be seen, for example, in the World Economic Forum's annual risk report that Fiona referred to earlier. What they've done, having looked at the global macro trends that inform the Yara's markets, is that they've then drilled down at the bottom of the screen into the risks and opportunities that emerge from those megatrends and that affect Yara in particularly. So they've translated the megatrends into company risks and opportunities. So on the opportunities side, they identify things like the use of digital tools to enable new market channels and reduce the yield gap through farmer connectivity. So these are things like drones and satellite communications that help farmers communicate. On the risk side, they've identified things like there could be more environmental costs and taxes, but also in their risks and opportunities, they think about how their products might be affected. So they can see that there are opportunities from mainstream adoption of clean ammonia and hydrogen, which are products that they work on, but there are also risks because there may be less fertilizer demand given trends in natural capital. So an example there of links between global megatrends and company risks and opportunities, how they've been identified. Let's just look at another example briefly here, and this is from Nest's annual report. So Nest is a company based in Finland that produces sustainable aviation fuel, renewable diesel, and feedstock solutions for the chemical industry using science and technology to transform waste and other resources into renewable fuels and circular raw materials. So this extract comes from the company's annual report 23 and from the climate section. And it shows how this company has used scenarios to identify both risks and opportunities in different temperature scenarios. So the net zero world is equivalent to about a 1.5 temperature scenario, the base case about a 2-degree scenario, and the compromised climate targets in the final column there is more a 2.5 to 3 degrees scenarios. Now they've looked at these different scenarios over a time horizon that goes out until 2050. And the extract shows their overall assessment of whether the scenario suggests risks and/or opportunities for their organization. I won't go through the detail, but please have a look at this in detail if you find it inspiring. But the important thing to note is that, as we said earlier, risks and opportunities can result in financial impacts. And right on the bottom line, you'll see that in each case, the company has identified whether the risks and opportunities give an indicative financial impact on Nest, which is positive or slightly negative or in line with their base case. So for this company, the lowest temperature scenario, 1.5 degrees, the net zero world, gives them the most positive indicative financial impact because their business model is to produce sustainable aviation fuel and circular raw materials, and is therefore giving them the maximum opportunity. So here's something we mentioned earlier. When we're thinking about how are we going to approach these disclosures? How are we going to get the data? How are we going to prepare our information? The IFRS standards recognize that this can be difficult, and therefore they give us what are described as proportionality mechanisms. Now, I've already mentioned this, that in applying certain specific requirements, a company is required to use all reasonable and supportable information available to it at the reporting date without undue cost and effort. So this means that the company doesn't have to do, go to unreasonable lengths to fulfill its reporting obligations. So what do we mean by reasonable and supportable information? Well, it's information that's specific to the company. We saw that in the Yara example. They've looked at specific risks to them. It takes account of the external environment, and perhaps the Nest example was a good example of that, because they were looking at what scenarios suggested would happen in the external environment in different temperature outcomes. It includes information about past events and current conditions that the company will already know, but also takes account of forecasts. And in some cases, what is proportionate, reasonable, and supportable is specified by the sustainability disclosure standards. And the other thing to add is that this reasonable and supportable approach is to be undertaken in a way that is commensurate with the skills, capabilities, and resources that the company has. I'm now going to hand over to Fiona to take us through the next part of this module.
Brilliant, thanks, Lois. Okay, so we are now moving on to looking at evaluating under the implement strategy area. So once risks and opportunities have been identified, companies are going to need to evaluate the financial effects of those risks and opportunities. And of course, this can often be one of the most daunting aspects when you're first starting out. And I know a number of you highlighted in the gap analysis exercise that this was an area that you were thinking would be a gap for you. So we're going to briefly review a few of the key concepts to help you with this process. So to help investors understand a company's resilience against climate risk, S2 requires disclosure of information about the implications of climate change on strategy and the business model. And it also asks for companies' financial and operational capacity to adjust or adapt over the short, medium, and long term. So, for example, you might test your company's resilience against new regulation, perhaps to limit certain high emissions activities, or your company's ability to respond to changing crop yields due to more frequent extreme weather events. So to do this, you're going to need to use scenarios based on science and analyze how these scenarios will lead to the company incurring effects. So important here is that the scenario analysis doesn't require you to predict the future. It's not a tool to forecast in that sense. It's really just about testing your resilience against plausible potential futures. So not predicting them, but just considering what might be possible and how you might adapt to that. So S2 doesn't specify particular scenarios for you to use because those will need to be specific to what you're looking to assess and the industry you operate in, etc. But it asks that you use relevant scenarios, that you provide information on how and why you selected them, and you disclose the assumptions used in the assessment. So considering this overall, the scenario analysis approach that you're asked to use under the ISSB standards is one that is commensurate with your circumstances and that uses all reasonable and supportable information available to you without undue cost or effort. So let's see a couple of disclosure examples here of how some organizations are approaching this. So here we have Cemex, which is a Mexican buildings company, and they use scenario analysis within their integrated reports, illustrating how they kind of expect different risks and opportunities to play out under 3 different climate scenarios, which they have drawn from the IEA, or International Energy Agency. So here you can see the different risks and opportunities and whether they expect those to be relatively more likely or of higher impact under different scenarios. And alongside this, they disclose information around the source of the scenarios, the temperature ranges, and the main assumptions that underlie each scenario within the annual report itself, which is obviously as important as disclosing the results. And so what's interesting overall here is that they're expecting to see significant opportunities, and that for them, they expect this to outweigh the risks. But what also is quite important is that they provide interconnection here with their overall approach and their strategy relating to their net zero targets and their risk management. So it's good to see that these practices are being connected together and ideally avoiding duplication. So, of course, anticipating the materiality of future events can be quite challenging. We fully appreciate this. So to help with this determination, IFRS S1 asks you to consider a number of issues to help you with this determination. So you could think of this list here as identifying all the steps and information you need to come to your judgment. For example, companies should be considering both low probability events and also high impact ones that might not be very likely, but would be a high impact if they did occur. And uncertainty relating to future cash flows should be evaluated. So another important point here is that this does need to be reassessed within each reporting period. So fully appreciating that there are a lot of uncertainties here, but what's most important is that you're being transparent about these uncertainties and you're continuing to assess those uncertainties and any potential ranges that there may be against the figures you're providing. Okay, great. So back over to you, Lois, for the next segment.
Thank you, Fiona. So now we're looking more at how you develop processes, new ones, or use your existing processes for preparing for your disclosures, sustainability related disclosures. So what considerations might you apply? Well, first thing to say is the good news is in any company, there's likely to be some processes that can already be used to support sustainability related financial disclosure. And you'll be surprised how much information is already available when you really take a look. So the company's management should assess those existing systems and processes to determine whether any new systems or processes are needed and whether anything needs to be adapted. So how might we do this? And I think some of you have mentioned this already in Mentees. A gap analysis is perhaps the first step to check whether there are gaps in existing systems and processes for collecting or processing information that's needed for disclosure. Secondly, what is the suitability of the existing process? Is it suitable in terms of perhaps the timeframes over which it operates? We know that sustainability disclosures are often for the future, and therefore we need to ensure that our processes look across the appropriate time horizons. Similar thing applies to prioritization criteria. So in some cases, criteria may be limited to likelihood and probability, but for sustainability, because of the characteristics of the risks and opportunities, it may be that new criteria should be added to the prioritization process, including impact, vulnerability, and speed of onset. You could look at the controls processes used in the company to evaluate whether they are suitable for sustainability disclosure, and also who you need to be involved, which contributors are necessary, what departments have the relevant processes and expertise to contribute towards the sustainability disclosures. Each of these things, of course, can't be looked at in isolation. There will be interconnections between different and internal and external factors that affect your sustainability disclosures, and those interconnections should be reflected in any update to systems and processes. Of course, there will always be uncertainties from sustainability risks and opportunities, and uncertainty is quite inherent in this type of disclosure. And the processes and systems should have a means of dealing with those uncertainties. So what criteria will be used when we encounter uncertainty? And finally, what resources are available to manage your existing processes, or to develop them further, or to implement and design new processes? Do you need to go through some sort of change management request internally to apply for new resources? All of these are considerations when creating or adjusting new processes. And there's a link there to a World Business Council for Sustainable Development handbook on disclosure that gives more information on the types of considerations that might be relevant for you. Now, the next thing to mention when thinking about process is maybe thinking of developing a disclosure plan. The development of a disclosure plan, as you've probably seen already, is what we're asking you to do as part of your homework. What we mean by a disclosure plan is a standalone strategy, or could be part of a wider disclosure strategy that does various things. I mean, first of all, it enables you to take control of your narrative. It's your company, your management's decisions. The standards ask management to use their judgment. So the disclosure plan can help you set out how you're going to do that, to take control of the company's narrative rather than simply responding in a tick box manner to the requirements of the standards. It can support the sort of internal collaboration that we've been talking about. So you share knowledge across different functional teams, and maybe with external experts as well. But most importantly, a disclosure plan can be a reference point, an audit trail that year on year sets out where and how judgments have been made, for example, on how you'll deal with uncertainty, which individuals and departments were involved, how they were organized, how data was sourced, which systems were used, whether you had assurance for some or all of the information disclosed and where the assurance came from, what different goals and requirements were being managed, which standards or guidance were being used. If you record all of this in a disclosure plan, it becomes a permanent record you can look at the start of the reporting process each year, and should make your disclosure journey a bit easier, we hope, and that's why we've suggested it for your homework. Here's an example. It's quite an old one. It's from 2022, but it gives you the idea of what we mean by the sorts of things you might consider in your disclosure plan and then note down in your disclosures. So this is an example from the British property developer called Hammerson. And what they've done here is they've set out the basis for their reporting. So they tell you what period it covers, what activities it covers, where you can find different pieces of information or more detail on the disclosures. It tells you the methodologies that are used for some of the environmental disclosures, which boundaries are used, so whether the company includes all of its subsidiaries and operations, or which other boundaries were used. It tells you the approach and scope for data collection and verification and other contextual information, all of which helps the reader understand the data and how it's being prepared, which framework standards, methodologies were used, which companies were included in the case of a group of companies. So as I said before, agreeing this before you get to your disclosures is likely to be helpful. Let's look at a Zoom poll now. You can only have one answer here. Select one answer. So the question is a disclosure plan required by the IFRS sustainability disclosure standards? And you can answer yes, you must disclose your plan, or no, but it's a very helpful tool. What do you think? Slightly slower response speed here, so we're thinking about it, which is good. When we get to 50%, I will end the poll. Here we go, and share the results. So 61% of you said no, but it's a very helpful tool. 39% of you said yes, it's a requirement and you must disclose your plan. Those of you that answered no are correct. So the majority of you were right, and well done, because we work with many audiences and often this question is answered incorrectly, but you have answered it correctly. There is no requirement in IFRS sustainability disclosure standards for a company to have a disclosure plan. However, we've set it for your homework because we think it's a very helpful tool to support your disclosure processes. So well done with that. I think we might have another poll. I can see that someone said the poll is not showing, so maybe our background support can just have a look at that. But hopefully many of you can see this particular question, which is, a disclosure plan can help a company to take control of its narrative within general purpose financial reports, support collaboration, knowledge sharing, and team discussions, act as a reference point and audit trail for disclosure preparation, or the plan can help a company to skip full disclosure as prescribed by the ISSB. I think the poll must be showing to the majority because I can see that people are responding. There's a very clear pattern emerging here, so I'm going to end the poll and share the results. Of course, you're all correct. It's the first three things. The disclosure plan is not, does not help a company to skip full disclosure as prescribed by the ISSB. So well done, all correct there. And I'll hand back to Fiona to take us through the Module 3 summary.
Great, thanks, Lois. Okay, so a quick wrap up from me again on what we've covered in this module. So firstly, let's come back to those connections. In the last module, we highlighted the importance of connections between those 4 different core content areas. And we've then learned in this module that there are, of course, many connections as well between a company and its external and internal environment. And these connections are really what we need to focus on when identifying key risks and opportunities. The second thing we talked about here was relating to evaluating those risks and opportunities. And a key component of that evaluation is consistency in your assumptions. So using a scenario analysis can be a helpful tool as it can help you to keep track of them. And finally, we've seen here that even if some of this data is not data that you're already disclosing, you might already be collecting it for different reasons. Or you may have the appropriate practices or processes in place to collect the data that you want to start reporting. So something perhaps that you just need to adjust. So trying not to start from scratch where it's possible to and looking at what's already there to support you is definitely something we'd recommend. So with that, we've got just a quick exercise. I'm going to need to move through it quite quickly just in the interests of time, but a quick exercise just to get you to think about what some of those gaps may be in your organization. So building on those gaps that we've identified in the last section, here we want to think about which of those gaps might require new processes or systems in place to support you in achieving your disclosure objectives. So that could be around data collection processes, maybe thinking about how you manage the data, or how you might integrate it within your existing processes and strategic decision making. So we've got the link, I think, to Menti close by in the chat, and thank you, Lois, for sharing it again. So we'll just do that a quick couple of minutes on this together just to see what your thoughts are on this question. So here, just to pause on really is, if you're already collecting some data here, perhaps for sustainability, perhaps for other purposes, maybe have a quick think about what are those processes that you might already be using that could help you in collecting this new information on sustainability risks and opportunities. And again, this is just a quick question to get you thinking, but of course the disclosure plan homework assignment is helpful to build out your thinking on this a little bit further, because of course we know this is quite a complex topic, but I'll give you a second just to see if you have any immediate thoughts on this. Good to see a couple of responses coming through now. So using financial systems, use of bank customer data from big data, it's interesting. Using business operational systems to extract relevant metrics such as energy consumption, employees, surveys, the ERP system, reviewing the ecosystem of what's available in the organization. Maybe using industry statistics. Yes, that can be a good source. Perhaps if you don't have some of this data internally, using operational information, financial surveys, tweaks to existing systems around HR, etc. Yeah, brilliant. So I think those are definitely all things that we'd recommend. So as I think has been highlighted, using existing ERM processes is definitely very helpful on the risk side of things. Thinking about the data management tools that you may already have. For example, if you're already using XBRL for financial reporting, you may be able to use that same software to tag ISSB disclosures in time, which is something we'll talk about a bit further next. And finally, on the governance side of things, of course, as well, you will already hopefully have governance processes in place that might have been set up initially for sustainability that could be adapted to think about these topics as well. So yeah, just a quick exercise there to have a little immediate think on some of those points. Thanks for taking a moment to reflect there. But we hope that this has, helped you to think that actually you do have a starting point there that you can use to support you in this area. And it's really just around, building from that, continuing to sort of prioritize that hierarchy of getting from estimating things and using qualitative information to start and building out quantitative information on material aspects. Okay, with that, I will hand over to Robert, who's going to take us into the final module on communications.
Yes, great, Fiona. Thank you very much. Indeed, now we'll be moving to the final module, module 4, on communication and how the report should be presented to the stakeholders. Just gonna move the slides. Right, and here we'll be focusing on when and where of the disclosure sustainability related financial information. And in this final unit, we will have three main sections. We'll be talking about the location, the timing, efficiency, and the confidence. So to get us started, let's look at the location and where the disclosure should appear. In this section, we'll be looking at where the sustainability disclosure should be located. Before we will dive into that, there's a little bit of a context here. So let's think about sustainability disclosures in the context of a complete reporting package that is useful to investors. And investors already have access to companies' financial statements, and ISSB standards are designed to identify sustainability-related risks and opportunities that complement financial statements. These all come together in a reporting package, and we call it a general purpose financial report. So the requirements in ISSB standards about what information to report are based on existing sustainability reporting regimes, focused on investor information needs, and on aspects of financial accounting standards. GRI standards, in a contrast, expand on sustainability metrics relevant to broader societal concerns. ISSB and GRI reporting standards share some content requirements, for example, what to report, but ISSB standards are focused only on investors' information needs and decision-making, reflecting the mission of the IFRS Foundation to bring transparency, accountability, and efficiency to capital markets around the world. So both organizations take different approach to defining materiality, but they are not competing. The GRI approach is set out and understood among sustainability practitioners, whereas the IFRS approach is familiar to accountants and relies heavily on management judgments. All right. Just to finish on the previous slide. So together, these frameworks enable the companies to meet the growing demand for transparent, consistent information across financial and non-financial dimensions. A simple example is where double materiality assessment identifies that some of the company's impacts may also create sustainability risks, which could be so significant that they are important to disclose to investors. So let's now again refine what is meant by material information in the meaning of the ISSB. As we just noted, materiality has different definitions for different reporting standards and audiences. So let's briefly recap what we mean by material information. In identifying material information to be disclosed, a company will first need to identify the sustainability-related risks and opportunities that could reasonably be expected to affect its prospects. So once the company has identified those risks and opportunities, it can determine what information to provide about those risks and opportunities. This is where our materiality definition comes into play. The definition on material information used in S1 is based and aligned with definition found in IFRS accounting standards. So if it is information that if omitted, misstated, or obscured by other information could reasonably be expected to influence investor decision. In other words, the ISSB standards seek to identify disclosure of key information that matters to investors. An entity determines what constitutes a sustainability-related risk or opportunity based on its facts and circumstances. Entities often have well-established processes already in place for identifying, assessing, and responding to sustainability-related risks and opportunities as part of the management of their business. And now let's talk a little bit on disclosing of material information. So investors have asked for disclosure of material information, and the ISSB standards have been designed to help you gather and disclose it. However, this means that the company does not need to disclose information that is not material, even if the ISSB standards include it as a specific requirement. So remember, to ensure that material information is clearly identifiable and that you use plain language, ensure material information is not scattered across disclosure, and include any additional non-material disclosure if required by regulators, but ensure that it's clearly identified as such. So now you in a chat, there was a link posted to their further educational material providing guidance, IFRS material providing guidance for companies on identifying and disclosing material information on sustainability-related risks and opportunities, which we encourage you to look at. And with the next, we want to have another poll, and just to get check your understanding on the information on what it should be disclosed in the annual report when applying ISSB standards. And there's more than one question possible to answer here. And then so let's select all that apply. So A, if meeting the information could reasonably be expected to influence investor decision, is that a material information? B, it could reasonably be expected to affect a company's cash flows, and C, it exemplifies the values of the leadership team. So which of those characteristics would constitute a material information? And I see answers coming in. There's a bit of a split, but there is a good pattern, and so I'm going to end the poll. Most of you answered correctly. Yes, so the correct answers are A and B. So that's about influencing investor decisions, and then it's about the financial prospects, so affecting the company's cash flow, information that can affect company's cash flows that should be deemed as material. Is not about the values or of the leadership team. So the answer C is incorrect. So A and B are correct in this case. Right. Now let's then move to the next part, and we'll be talking about where, and so about the location of the for the ISSB report. Disclosure under the ISSB standards has to accompany the financial statements and be part of the same general purpose financial reporting package, but as one does not say where in the reporting package the information shall be provided, this is designed to allow jurisdiction-specific requirements on the location of reporting. The most important factor to consider here is to ensure that sustainability disclosures are provided as a part of the same reporting package as the company's financial statements. Sustainability disclosure must be provided at the same time as the related financial statements, cover the same reporting period, and be authorized by the same body or individual authorizing the financial statements. And to reflect that, how that could be done in practice, we have an example for that, and handing over to you, Lois.
Thanks, Robert. Yes, this is an example from a company called Ayala, which is a Philippines-based conglomerate. They have lots of activities, property development, banks, healthcare, technology. So a big company with lots of activity. And this is an example from their integrated report. And in line with integrated reporting, we're seeing inputs of capitals into the business on the left-hand side, financial, intellectual, human, and social and relationship. We see the value creation process in the middle, And at the end, we see what value has been generated through that process. Now, the interesting why we're showing you this result to support what Robert has been saying is how you might disclose information in a way to show where it can be found and how to present it alongside lots of other information that you might want to produce. So in this example, you can see the blue arrows point to page references where information can be found. So even though we have financial, business and sustainability information presented together, this navigation within the context of the value creation module helps us get easily to the pages where we want to find more information. So it's a good content and navigation guide, but also presented in the context of the overall value creation model, showing financial, business and sustainability information together. Back to you, Robert.
Great. Thank you, Lois. And now be talking a little bit about technology and the development there. So technology is an emerging consideration for disclosures, and increasingly corporate reporting is moving away from PDF reports towards information on web pages with structured data sets, such as those databases offered by stock exchanges. And the IFRS Foundation has created the ISSB taxonomy, which reflects the requirements and accompanying materials for the ISB standards. So the taxonomy does not introduce any new requirement. A digital taxonomy provides the common elements or tags needed to make your sustainability disclosure machine readable. This makes it easier for large data sets like information from an entire industry and bring them all together to analyze them. So digital reporting has a number of benefits. It makes the report information easier to use for analysis. Data is structured the same across businesses, and it's machine readable in a machine readable format. Tagging information potentially allows for automated checks for quality and consistency. More and more data collection management systems are compatible and with digital reporting taxonomies, improving processes and report preparation. Yes, and now we're moving to the next section in the module communication. We talk about the efficiency and how to communicate efficiently and effectively. So following the discussion on location and timing, let's think about efficient disclosures. We added the training because a common command we find from companies is that there is growing reporting burden, but we hope that to highlight that when done correctly, efficiencies can be made to reduce that burden. So first of all, it's important to understand what the effective communication looks like and what is required. Often companies think that if they just pull all the information they have into a report, then everyone will be satisfied. However, this is not the right approach, and it's again against the core concept, in particular for presentation. So, for example, it could be helpful to ask this question: is this information clear and concise? By clear, we mean that, and the definition of what is clear might depend on the nature of the information. For example, whether it could be clear to present information in tables, graphs, diagrams with accompanying text. And then we need to ask the question, or should ask the question about the information, whether it's concise. And by too concise, disclosures need to avoid boilerplate information, unnecessary duplication, and the use of clear language. So some preparers watching today might be thinking to themselves that they still don't see what is the fuss about. Perhaps the experience focuses on standalone sustainability reports, or they haven't had much interaction with external audit. So to all the accountants watching, I say be kind to your colleagues. Help them understand the difference in rigor that is required in data collection, oversight, sign-off for financial statement. This means, for example, disclosure includes comparative information and are to be restated when necessary. Disclosures should avoid unnecessary duplication and use cross-reference when required or as required. Information has to be materially connected and aggregated or disaggregated as appropriate. So the other important feature is cross-referencing. So as you may have already noticed, there may appear to be some overlap in the disclosure topics. For example, you might have the same governance approach for all the sustainability issues. So then rather to duplicate the certain information, you can use cross-referencing. And cross-referencing to other reports is permitted as long as the other report is available on the same terms at the same time as the sustainability disclosures. The cross-reference information is assumed to become a part of the reporting package. Cross-referencing shall be applied consistently and transparently, and it should not result in information becoming more difficult to understand. And again, on that, we have another example and will be presented by Lois.
Thank you, Robert. And this is an example from a company called CRH, which is an Irish manufacturer and supplier of products for the construction industry. This is from their 2022 annual report. Now, this is an example about disclosing the impact of climate change and emissions reductions targets and how they've been considered in financial statements. Now, I should note that the IASB and ISSB are debating the way in which climate change risks and opportunities should be reflected in financial statements. At the moment, there's been some educational guidance issued, and perhaps one of my colleagues will pop that into the chat box, a link to it. But let's look at this example because it is actually very similar to one of the examples that's been published in the educational material. So at the start of the paragraph, we can see that climate-related risks and opportunities have been identified, and the company tells us how those risks and the reduction efforts have been considered in the preparation of financial statements. So in the middle of the diagram here, you can see the title, Climate Change and Carbon Emission Reduction Targets References. And the references are to page numbers where you can find disclosures in the financial statements about impairment testing of goodwill and property, plant and equipment, useful lives of assets, provisions for liabilities, inventories and retirement benefit obligations. Now, these are all items which must be disclosed in the financial statements. And what the company is telling us is that we know we've got climate-related risks. We've told you you can identify them on pages 56 to 59 of our TCFD disclosures. These are the line items where we have considered the effect on those lines of those climate-related risks. So we know that they've considered this. We know that they have considered these types of risks in line with the judgments and estimates the directors regularly make to prepare the financial statements. We can see that in the paragraph just under the middle box. And then at the bottom of the page, they tell us that in reviewing the financial implications of the risk, the companies conclude that there is nothing material for them to disclose. So they've looked at impairment, they've looked at whether they need to make a provision for liabilities, for example, and they say that there are no material impacts that they need to take into account. Now, you might ask yourself, well, why are we showing this example? If there's nothing to disclose, what is the purpose of the example? Well, the purpose is to reassure the reader that the company has at least considered the implications for these line items and pages listed of the risks that they've identified. In the absence of this information, a reader might be thinking, well, you've told me you've got risks. How do I know whether those risks will translate into into financial implications, and the similar point refers to the targets. You've told me you've got targets to reduce your carbon emissions. How do I know whether that will result in costs or the need to make provisions to set money aside? So in explaining that they have considered the financial impacts of the risks and targets, this company reassures the reader that they have gone through the exercise, even though there's nothing material to disclose. So I think it's back to you now, Robert.
Yeah, thanks, Lois. Yeah, we'll be now moving to the next topic. We'll go briefly through this one. It's some mechanisms that support the adoption. So we have sought to apply a number of measures to support preparers to get started with the ICB standards. So one simple thing put in place is to adopt the well-known terminology and concepts familiar to preparers, coming from the IASB, for example. Secondly, many requirements in S1 and S2 are to be applied proportionally, recognizing that companies might be on a different stage on the preparedness journey. So you will see the phrase often all reasonable and supportable information as the reporting date without undue cost or effort, or commensurate with skills, capabilities, and resources in a number of places. So this is to allow certain flexibility of the company without straining on the resources and capabilities. And there are also a number of reliefs for the first year of application has been introduced. So companies being able to limit disclosure to climate in the year one, or companies being able to provide annual sustainability-related financial disclosures with their next half a year reporting rather than at the same time as the financial statements. And in respect to Scope 3 emissions, when applying a greenhouse gas protocol, if they are already using a different measurement approach or provide comparative information in the first year of reporting using S1 or S2. So these are the number of available reliefs, and then please refer to the S1 and S2 standards for the detailed list of these reliefs. Now I'm going to the next poll, and we'll be then ask you a question about the information and then the qualities of this information. So there's multiple options here, multiple choice question here. So select all the features which apply. So the information disclosed in accordance with the ISB standards should be decision useful, material, misleading, and comparable. Which of these are correct? So I hope that it should be pretty straightforward. And I think we already have a good response. Of course, the information should be decision useful, material, and comparable. It should not be misleading. So answers A, B, and D are correct. Answer C is incorrect. And going to the next questioner, information is decision useful if it is. And then we have 5 options. It's relevant and faithfully represent what it proposed to represent. Is comparable, verifiable, timely, and understandable. Which of those 5 are the criteria for the useful information? And again, I'm seeing a good responses here. All the answers are correct. So all of these elements are then constituting a useful information: A, B, C, D, and E. All right, and we're now moving to the next last section on the communication. So finally, the last section of the last unit looks at how and we can ensure that the users of financial reports have confidence in the data you are disclosing, as trust is an essential component of sustainability-related disclosures. So it's important, the trust, an important trust builder is showing data and trends over time. This is why ISB standards ask for comparatives. Some comparative information provides context, helps to indicate the progress, and underpins the strategy and risk management. And the metrics disclosed by a company might be redefined or replaced over time. So it's important that the company revise the comparatives to enable investors to compare and analyze current period figures with relevant prior period figures. So in case there are material errors, in this situation, the company is required to restate these errors in the comparatives period. And the revisions or restatements are necessarily only when there is a risk that this material information being omitted, misstated, or obscured can result of not revising or restating these comparatives. All right, so yeah, and finally, it's important to build confidence by providing clear statement of compliance. A company that complies with all the requirements in the ISB standards, even the release, is required to make an explicit statement of compliance. And we are publishing further guidance on this. Sorry, that's not relevant. So things to remember at the end. Please work through this list. So ensure about the qualities and characteristics of the information. Make sure that the investors can understand connections between the sustainability-related risks and opportunities, the disclosures on the core content and sustainability financials, and the connection between the sustainability-related disclosures and financial statements. And then remember about the quality and that the information is provided for the same period and the same reporting, that it covers all material information, it includes comparatives, and at the end includes the statements of compliance. Sorry for rushing at the end, but we are a bit short on the time. So yeah, that's it from me on the communication part of module of this training. Over to you, Fiona.
Great, thank you so much, Robert. And apologies, because you always take the last section, so we leave you with the hard work of catching up our timings, but thank you for that. And we hope that was still useful for everyone. So as Robert says, this is our final module. So before we wrap up, we're just going to take a quick moment to recap on what we've learned in this module. So we discussed where to report information, and what was important here was thinking about the audience or who you're reporting to. So make sure to be clear from the start who the primary users of the information are, and this is going to help you ensure that this information is the right information for their needs. We then discussed efficiency, and I think the key takeaway here is really that less is more. So the objective isn't to overload investors with information. Actually, that can be harmful to obscure information that's required. And using the standards can help you get started here as a guide to what information investors really want to know about, which is, of course, the purpose of the ISSB standards. And finally, we discussed report user confidence, and especially in the current climate of greenwashing accusations, legal battles over public statements, etc., you, of course, want to ensure that your data is not only accurate, but that it's presented in a way that builds confidence among report users. So the reporting disclosure plan that we've been discussing as a voluntary element that you may choose to pursue can help you with this, as if it's done well, you're going to have a clear and documented process for reporting the data investors need. Okay, so we don't unfortunately have time for our final Menti exercise today, which is around communications, but we'd encourage you to look at the handout that we shared with you before in the link on the webpage, which includes this homework, so you can take away that exercise to also do there as well. But I will share with you just this final Menti that we have now, just to get a sense of where you are now with your comfort and understanding on the topics that we aimed to help you with today. So hopefully, feeling a little bit more comfortable, albeit I know that there is a lot to take away from this, and often just the starting point of the journey to take away and think about the resources. But I see a lot of people have moved up that scale. So that's brilliant to see people feeling a little bit happier with these areas and feeling that they can start working on developing that strategy and using the standards. That's fantastic to see. Okay, so I think we have one more question as well, which I'll leave open for you as well. Always good to get your feedback on any good areas of the training in particular, or perhaps anything that we can do differently as well. So feel free to let us know. But in the meantime, whilst you're having a look at that, I'll just run through a few final closing points from our side as well. Okay, so I mentioned a few times our homework exercise, but also we just wanted to mention this again for you to cover off a few points. So as I've said, obviously we understand that this is an interactive time we've had together today, but of course, often the beginning or just one stage in the learning journey on this topic. So we want you to ideally take away this homework assignment, which you can find on the event page that Lois has shared. And you'll see that the homework follows the same structure as the interactive Menti exercises we've been completing in today's session. So it takes you through considering those 4 different steps of preparing, alignment, implementation, and communication. So if you follow through the structure of the assignment, it hopefully should enable you to develop that draft disclosure plan for your company, allowing you to put into action what you've learned in the training today. So we really do encourage you to take that away, to complete in your own time, or just use it as a discussion tool, indeed internally, to share with your colleagues as well. So just to land on a few final resources, which you'll find again in the handout that will help you with your learning journey here. So of course, we have the IFRS Sustainability Knowledge Hub and Broader Knowledge Hub, which covers all the relevant resources that we've mentioned from the IFRS team today. So that's a great place to go to find all of that information. And there are, of course, the standards themselves as the ultimate resource to go back to at any point if you have any doubt about the requirements in particular. And then we were joined by our colleague Rose from IFC earlier in the session. And I know this is probably what she would have wanted to share if her audio was working, but IFC provide a lot of resources that can help you on these topics as well through their online platform, their knowledge hub, and their dedicated training and capacity buildings offering. So recommend checking out those resources from the IFC as well, which can be very helpful, particularly when it comes to really strengthening those internal practices and governance processes. And I'd be remiss if I didn't give a final mention to the SSE's resources as well on this topic, which you can find in the UNSSE toolkit online relating to this topic and other aspects such as climate disclosure. And we're building out new guidance on different topics all the time as well, so be sure to check that out. So a big well done and thank you to everyone who stuck with us for this full 3.5 hours of training. We recognise that is a long time to invest in your day and there's a lot to cover. So we're really grateful for your time and attention throughout this. And would like to thank you in particular for all of those questions and engagement that you gave us throughout the session, which is always great to see. So as a merit for your hard work, you can now receive a completion certificate for taking part in this course. So to do so, you'll need to complete a feedback survey, which Lois will be shortly sharing a link to with you in the chat box. So if you follow that link, it will allow you to complete the survey and then you'll receive your certificate in follow-up. If you missed the link in the chat, you can also access this through the email that you're going to receive within the next 24 hours from Zoom as well. And I see Lois has just shared the link there. So if you look out for the email from Zoom as well, if you do miss the link, you can follow it there. Once you have completed the survey, please give us up to a week to receive your completion certificate before you follow up with us, as it sometimes just takes us a bit of time to process all of those. And also make sure to double check your junk email folders if you are waiting for a certificate from us. So sometimes certificate can disappear into those folders. So make sure to check there if you are missing it. So to close us out, we just want to say a few final words of appreciation. Firstly, to the network of SSE supporters who help to support this programme. And of course, to the direct supporters of this programme, the IFRS team, Bella and Robert in particular, who joined us today, the IFC, and of course to the Nairobi Securities Exchange, Demi and all of the team there who've hosted today's session with us. We so appreciate their support to make today possible. And of course, a final thank you to everyone here who's joined us on today's training. We so appreciate all of your feedback and engagement and wish you all of the very best with taking this forward in your organisations. So we'll close out there and thank you very much, everyone, again. Enjoy the rest of your day. Take care.